Good morning, everyone. We are just gathering, and good to see people before time. Yeah,
Good morning.
good morning.
Good morning, Sandeep ji.
गुड मॉर्निंग राठी जी।
भूल गए क्या?
अरे नहीं सर, आपको कह रहे भूलेंगे। तो मैं बता रही बहुत दिनों बाद में कनेक्ट करेंगे। इट्स बीन लॉन्ग टाइम। यस सर।
राठी जी, good morning. Sandeep, good morning.
Good morning,
Good morning,
Vaibhav.
good
Good
morning,
morning.
After a long time, huh?
Yes sir.
Yes.
Good morning to everybody.
Good morning, sir. Good morning.
sir.
Yeah.
This is S Rathi, Sumedha Fiscal.
Yeah, I have heard. Yeah, see, I am Narendra.
I know, sir. You don't have to introduce yourself. Everyone knows you.
Sumedha
need to
Fiscal
introduce.
is a very known name. I know.
Thank you, sir. Thank you so much. Thank you.
Good morning, Narendra.
Good morning, Vaibhav.
How are you?
Fine, fine.
The
How
kind
come?
of sessions which you have taken on NCube is really keep us all informed a lot.
Yes, I say घर में बैठने से सोचा तो covering the banking, finance and all. अभी आप सब वही you are also following same pattern. It is a good in a way because the more the knowledge, more the people will be aware and they will be taking no corrective steps.
Sure.
So अभी थोड़ा time ऐसे ही रहेगा because virtual we have to be in virtual only, I think.
Yeah, to an extent, it's correct.
Yeah. So with that, we will continue that effort in this new year also. So of course, I take this opportunity to wish each one of you all the best in the 2021. Happy New Year.
Same to you.
Yeah. Thank you.
Good morning, everyone. It's 11 a.m. The time to start. However, I find a lot of people are joining in. So would like to take like next 5 minutes to get the gathering on, and then we'll start the session. Just 2 minutes more. Good morning, everyone. We are right now 67. That's a big good number, and I'm very happy considering the stalwarts today and the subject of importance. People have been very enthusiastically on this Saturday morning been coming forward over. Well, at the start, I would like to wish everyone a great 2021. Like, it is always said that it's 2020, WN1. So we look forward that whatever has happened in the past year would actually get conquered by the people in this current financial year, or the what we have at the calendar year. To start up the session, I would like to call upon Ajay to share about the market scenario and how it looks ahead. Yeah, Ajay. Ajay, you're on mute. Ajay, you're on mute.
Sorry. Sandeep, I think I would like to take the questions on market maybe at the end of the session, that is in the our open round session. But yes, definitely I would like to welcome everybody on this particular conclave, and the topic that we are covering more is on the NCLT and restructuring and IBC laws, and what are the impact of it is on our companies and others. I think we have got a very select and very eminent panel of experts here, and I believe when experts share some information, it is like if you hear them for 1 hour, it is as good as taking 50 hours of your own studies, and you do not know what is the actually you may not come to the right opinion. I think hearing them out even for 1 hour will be, according to me, equal to 50 hours. So if you are doing 2 to 3 hours in a week, I believe we are really, improving. And I have always been suggesting people that just go through our seminars and webinars and conclaves, read through the presentations during the next week, the week after your session is over, and at least you just try to brush yourself on the topic. I think it will keep you abreast of the latest trend in the segments, because we are all from the financial segments, but we
Very
are
true.
experts in one particular part of the, so it's like a whole big machine, and we know only one part, or maybe a tool of the entire machine. So better to learn from the experts and become at least have a good opinion on what actually, so you can have a bigger picture with you, so that you can share with clients, you can increase your knowledge, and maybe improve in your careers and business. That is what I think I would like to say. I think the first person is I think Mr. Narendra, right? I think Sandeep, you can take over from now.
Yeah, that's nice, Ajay. In fact, when we talk about pre-COVID and the post-COVID, we really look forward for the credit environment,
Right.
how things will change, and definitely this today's sessions on IBC and CLT will give us good insight on what to look into things. Otherwise, we just keep looking and reading things everywhere, and we don't reach anywhere.
Right.
Very true. Okay. So just sharing about the think tank series. It's an initiative which we appreciate, like Manoj had started, or Manoj Alimchandani, and after that, it's been 10 years since we have been having these sessions. We are happy to have a lot of good people like who are into senior positions of CFO, CXOs, COO, CEOs, and senior positions who've been with us. We are really thankful to all of them for sharing their part of the knowledge and enriching us into the scenario. Okay. So before we go, I will request Manoj to share his thoughts on the subject and take us ahead. Manoj.
Thank you very much. Indeed, a pleasure and honor to be here with a galaxy of eminent panel and superb participants. We have eminent experts among participants with great knowledge about corporates, banking, finance, capital market, industries. And today we have indeed a wonderful panel. We are beginning a new year. I wish Happy New Year and a great 2021 to all the participants and the panelists and everybody watching the finance and banking conclave. I would like to acknowledge all the participants. It's really a full house. The series initiated by the participants themselves. The topics have been selected by the participants themselves, have received overwhelming response, and there is a request to continue the series. I was talking to a few participants and expert panel speakers last evening. Everybody has appreciated very much, and they are very, very keen to contribute to the development for the India growth story, and through the digital means of knowledge sharing and experience sharing. Wonderful to have Mr. Narendra here. He has been a stalwart Indian Banking Association. He put the IBA in the forefront to all global participants and how India can become a part of the global story years ago. And experience at chairman level, board level, independent director level. Mr. S Rathi is here, eminent chartered accountant, has a lot of interest in banking areas, restructuring, IBC. Mr. Sanjeev Pandey is here, expert in IBC, NCLT issues, always ready to share knowledge on any topic in banking. Mr. Shailesh, Standard Chartered Bank, expert in stress assets, resolutions. Wonderful presentations are coming by these speakers, stalwarts. We have Mr. Ramesh also, wonderful experience on credit rating side, looking at ratings of all financial sector companies, whether it is banks, whether it is NBFCs. We always do a deep dive, go into practical issues and look at the issue. The world has expectations from us, the foreign investors, the domestic investors, the financial institutions, the directors, the government, the stakeholders, the investors, to see everything, the key issues from a 360 degrees perspective. And everybody is ready and looking forward to the views. There is an open house. Anybody can ask questions on chat, and expert panel would endeavor to see that all issues, critical issues, are addressed in this conclave, and any further issues we can definitely take up in the series ahead. Every week, every month, more and more critical issues will be generated. I am sure more ideas will be generated in this finance and banking conclave. Idea is to have a gathering of maximum people, and this will be a regular event to watch from everybody's angle. And yes, can I ask, request Mr. Narendra to share a few thoughts on critical issues?
At the outset, I wish each one of you a happy and prosperous New Year 2021. I must really congratulate and appreciate the efforts taken by few intellectuals or the professionals, including Manoj and all others here, who have taken this initiative of think tank webinars. And I've been watching quite a lot of very critical issues. And as he rightly said, it is a deep dive or a deep dive. That is where you go into the depth of the subject with the experts brought from the industry. And as normal today, I think on both the experts on the resolution of stress assets as well as the IBC aspect, we have quite our people coming, I think, Mr. Maheshwari Rathi as well as Mr. Pandey. So, of course, I will be giving the overall view, what is the situation on the banking sector, Indian economy, and also on the today's two specific subject. So all of you are aware that one thing is today we say very, what you call, encouraging news that the yesterday government has approved for the first Serum Institute, that is Oxford, that vaccine. So that is because the government is already committed that around 30 crores in the next maybe period of 6 to 8 months are getting this vaccine. And already today is the all over India dry run. So this is because everybody was saying Indian economy, everything will be normal once we get into the vaccine. So now the vaccine is become a good issue. Of course, other than that also, the number of cases, even though India reached more than 1 crore, for the size of our population, it is much under control. And the percentage of recovery is more than 96%. And the number of incremental cases now, all of you are aware, that has been coming down. So that most of the lockdown, of course, in India, that thanks to our Prime Minister, that they took the lockdown much in advance, that is even in March itself. So looking back, it looks that it is a very wise decision in a sense that the space got for preparing ourselves in terms of health facilities and also giving up the medical staff, all that, and also getting the awareness of taking precaution. So, but there has been a large impact on the Indian economy. So that all of you are aware that the 1st June, that was a first of its kind of contraction of 24% to the Indian GDP, which would not have been there for some time, or it is not heard of at all. And as compared to the global, our percentage of that contraction was very high. But India has a killing spirit, or the spirit behind that the next quarter, that is by the end of half year, we could recover quite a lot, and that contraction came down to 7.5%. But prior to that, quite a lot of people were estimating that the India will have a very tough time. The contraction can be 14% for the full year, all that. Most of the rating agencies, including the World Bank or IMF, they were, of course, for 10% and all. Now, later Reserve Bank has now estimated that the contraction will be, because this quarter we will have a positive growth, that is up to December, and later it may be hardly up to 7.5%. But when you take into account the overall contraction in the terms of what we lost to the GDP, around 9.5% we will have. That will not be recovered at all. And today's paper also, in everywhere it is now mentioned that India's recovery in the 21 and 22 is much faster, but it is at a low base of GDP. That is, you have to be mindful of that the GDP will be low base. But the recovery may be even 10, 11% or so. Quite a lot of people are estimating that revised estimation. So that means we will be coming back. And if you have seen also, the manufacturing base has already come up. More than first time, I think 58.9% growth. And that is now reflected by the GST collection for 3 months in a row. And the last one is 1.15 lakh crores, which is again compared to 1 year back also, once we have reached, I think maybe, so it is still higher, 1.05 or whatever. This is much higher. And it is also reflected by railway freight, electricity consumption, and pickup of your tractor or some of the commercial vehicles. But the service sector has not been taking much improvement, and primarily due to the, like all of you are aware, the whether it is hospitality industries, tourism, or transport and travel or entertainment, as well as restaurant, and those part of that, even though they are all open now, the people's mindset has yet to be changed. So that sector is yet to see the growth. But India's GDP, more than 50% is contributed by the service sector. The manufacturing per se is hardly 16%. And the balance, of course, agriculture. And one thing is, agriculture is in very good this one, and it is shown around 3.4% growth. So the rural economy will come back much faster. The government, all the direct transfer, DBT, or the direct benefit transfer, which first instance 1,76,000 crores, and later also the food grain, all that, and also some of the benefit to the Narendra workers, up to 1 lakh crores of additional 40,000 allocation. all have gone to the rural area. And with the bumper crop as well as the rabi crop is also expected bumper. So with that, the agriculture will come back and their consumption pattern also will change. So we have that lack of demand which was there is likely to come back. This is as far as the overall Indian economy. And it is now also mentioned that China, India, and such of those emerging countries will take up the lead in the next year's growth rate also. And but the overall global growth rate in this year will be at a low level. And the regulator as well as the central government has taken quite a lot of measures and unprecedented liquidity. That is globally also, whether the Fed, all of their central what you call our government regulator balance sheet has swelled very high. And India, our Reserve Bank was also early, very fast to take up the measures of liquidity infusion. And now up to 12 lakh crores of liquidity has been infused to the Indian economy. Now, where other than that, around 29 lakhs crore of what you call Atmanirbhar Bharat Abhiyan by the government of India, which includes 12 lakh crores. So the government of India, on account of the direct benefit transfer or such upfront cash payment and all that, or the overall may not, that is a criticism that it is hardly 2 to 3% of the GDP, whereas globally people would have gone even up to 14% GDP, the highest and all. So they have not bothered about what is the likely impact on the GDP, and they have gone in excess of that and they have spent. But even in spite of that, India, our Indian government has to borrow around now 13 lakh crores of borrowing, as against the last year, what you call, no, it may be 6.5, 7. The overall original budget was 7.5 lakh crores. And the state government will be borrowing around 8 lakh crores. So that means 20 lakh crores of borrowing has to be absorbed by the market. That is where the Reserve Bank, not only the liquidity measures, they are also taking proactive measures to favorable situation in the market of reverse repo, that apart from reverse repo or the open market operation, as well as the switch of the securities. And they have ensured that the government is able to borrow less than 6%, 10-year yield. And the overall, that is now hovering around 5.80 to 6 only. And all the low, the smaller end of the term, all the commercial paper or the other treasury bill or the money market instruments, all or even the shorter bonds, all have come down, some of them even below the reverse repo rate of 3.34, and India's repo rate is 4%. So 115 basis reverse interest reduction and the pumping of money has brought in a very low interest regime. But the only threat to the this situation is the other side, the inflation has not come down. Now, even now, it is more than the RBI target of 4+2, that over that 6, and even so in India now the Reserve Bank has been consistently breaching this 6% for some time. But the projected inflation, they say by the end of the year or that it will come down. So there they are not anticipating that because the target of 4% prescribed by the government of India by the legislation, they don't want to change. So it will be remaining 4%. So the inflation is the one threat, because then the RBI has taken a calculated move between inflation and growth. Let us give more importance to growth. This, of course, has resulted in lot of reduction in the rate, and whereas the real return, or if you ask me what is the real return, this has become negative. So we are now going towards such a negative return, and people like senior citizen will be getting at a very low rate on their deposit. But the borrowers have been benefited due to the LTRO or the long-term repo or what you call certain measures. During the beginning itself and even up to now, corporates who are AAA, AA, and it is also known by the various report by the RBI that they have borrowed more than 10 lakh crores. Out of that, 8 lakh crores plus is mostly bonds. So their financial position of the top-rated corporates are all well now is fairly better. And it so happened the bank's deposits have been growing at 10 to 11%. over a period of 1 year, whereas the credit is growing only at 5.4. And sometime back, banks were depositing 4.89 lakh crores with the Reserve Bank at a hardly rate of 3.35. So the banks are getting a cut on their margin because these are all deposit rate may be in the earlier period at higher rate. So they are cutting, but the corporates have been benefited. So in the light of this, RBI also taken some of the regulatory measures, and one of the measure was the moratorium, which they gave up to May and followed by up to August. And in the initial period of the first moratorium, 3 months, whether in the NBFC or the banks, the opt of moratorium may be slightly higher. But later that has been now people would not have again availed the second moratorium. But the Reserve Bank report says now on an average, it is 40%. It may be some of the NBFC, it may be a little slightly higher, but as per the banking system, other commercial banks, scheduled commercial bank, average is 40. The number may vary. So these people are corporates, particularly, of course, those who borrowed money and all, they would not have opted. And in the personal segment, those who lost their jobs or those got the lesser salary and those they got frightened with these COVID, and the earlier period was thought that it will be over faster, but it is a longevity there. There they would have availed the moratorium. But the other side, NBFC as well as the bank, the collection efficiency has improved. Sometimes it would have come down as low as 35%. Today it has come to 80, 85 or 90%. So that means people don't want to default. And with the another measures taken by the Reserve Bank, which I think somebody will be presenting, is as a resolution of COVID-related, 19-related stress assets. Now, the KV Kamath has identified 26 sectors, and he has also, the committee report has prescribed some benchmark ratios to be achieved within the moratorium period of 2 years maximum under the resolution. So this resolution is different from the other June 7, 2019 circular, in the sense there within 6 months that you have to find out the resolution, and there you have to also find out if you want to become the standard account during this resolution period, you have to have the management change. But here it is without the management change. The only thing is they should be COVID related stress. So actually around 16 lakhs crores of assets are under stress under the COVID. And even before that, the India, because of the low growth rate of Indian economy, hardly around 4.2 in the earlier year, that there have been around 20 lakhs of stress assets, and that NBFC another 8 lakh crore of assets. So these are the what presumed by the Kamath committee. But now the report says that even though the people will opt for restructuring or resolution, it is expected 5 lakh crores, 6 lakh crores. Various people were estimating, but it may not be now 1 to 2 lakh crores. So the corporates, particularly those who are in the best bracket of rating, they would not have come forward. And only in the medium segment or those who are rated low and those who have been really affected by the COVID, one may be airlines or maybe some of the hotel industry, so or maybe some of the restaurant. These are the service sector related companies would have asked for such resolution. And in the personal segment, in fact, the people who opted are also limited. But MSME sector, for which you are all aware, the government took special measures of 3 lakh crores of emergency credit line scheme. Prior to that itself, the banks have given 10% emergency credit line, not only MSME, all the corporates also. And this particular scheme now, more than 2 lakh crores of 2.15 lakh, it may be now still higher, have been given as a sanctioned, and 1,65 lakh crores have been availed. And subsequently, as per the Atmanirbhar Bharat 4, that government has extended in line with the definition change, where even 50 lakhs of investment and 250 crores of turnover would be coming under the MSME. So accordingly, this scheme has been made available to them. Also, all these 26 sectors coming under the KV Kamath committee report, which actually would enable some of the and irrespective MSME also. So any other trading or maybe such sectors which are affected, and the scheme has been extended now. After October, it has been extended. So it has to be seen whether people will opt. And MSME got a special scheme under the restructure where earlier itself they have permitted for what you call extending their repayment up to December, now up to March 2021. And of course, that is another special dispensation has come to MSME. So the overall, the NPA level, now all of you are aware that trends in banking and report by the Reserve Bank, which is released, the beginning now some that no, this itself, if you read that I quote, during 2019-20, Scheduled Commercial Bank registered a robust performance characterized by improved asset quality, stronger capital and provision buffers, and return to profitability after a gap of 2 years. These improved, continued in the first year also, and even in pandemic aided by moratorium, the standstill asset classification and restriction in dividend payments. So another important, this of course I will not be reading fully, this that the first half year banks have shown around 27,000 crores of profit, and banks have provided in the first half year around 55,000 crores of provisioning. So even though due to the standstill by the Supreme Court, all of you are aware that they are given a standstill because there were petitions that these accounts need not be classified as the standard assets. So the market, or a few, all of you may be having little fear, as which is mentioned by the Reserve Bank also, that the current NPA level, which has come down substantially, may not reflect the true NPA. But what the banks have done, they have already provided in the first quarterly additional provisioning, and they have also disclosed such of those assets which are not coming maybe under NPA or stress, but we are not classified. So with the parallel raising of money by the corporate and all, that default ratio also are not likely. Otherwise, as per the financial stability report which released earlier, Reserve Bank has estimated that the NPA level of the banks will go from 8.5 in March to 12.5, and in the stress scenario up to 14.7. Now it is estimated by the rating agency all that the NPA level this year may be 10.60, and next year it may go to 11 plus. So that overall are under control. And only thing is the banks are now one side they are having a lower return on their investment due to the substantial reduction in the interest rate, and which at the reversal stage, like all these measures taken by the Reserve Bank, the liquidity and all and regulatory measures will have to be unwind after the pandemic is now means improved, and now vaccine has come. So RBI will slowly unwind the liquidity in the market. Other side, they have to also ensure that the inflation don't go, so that the interest rate will still remain low. Otherwise, there may be a chance that the interest rate in the market will go up, and that will result in depreciation to the investment portfolio of the bank. So that is the one threat to the investment portfolio of the bank. The other side, today credit is not growing, except maybe personal, like the housing. In the Bombay itself, now more than 10,000 registration of the new houses in the sense flats, and it is now all over India. The real estate sector has started improving. The people have thought that this low rate of interest, as well as the concession given by the stamp duty, as well as the low rates of 10 to 20% discount. But now the builders may not give that discount also, because demand is improving. But the housing loan would have improved, and banks may not be giving much on unsecured loans, but wherever secured personal segment, they may be supporting the segment. And MSME, of course, there is a slight time when they will pick up, because they are one important aspect of MSME is the payment which they are due to them by the corporates or the mid corporate, that is getting delayed, even though the government has prescribed that 45 days is the maximum limit. And now also the trade exchange has started, that has started improving. But you would have seen but that our Nitin Gadkari, Honorable Minister for MSME, has been concerning or mentioning concern that MSMEs have to pay it in time. and government payment also have to come in time. And that government once did around 60,000 crores they paid. So this is the MSME sector is the one which contributes more than 40% of the GDP and 50% of the exports, and also the employment for a lot of people. That has to improve. So this in this sector, I suggest that the corporate should start making equity with the MSME, which is supporting them. The government itself has come with the scheme for 20,000 sub debt, or it is in lieu of equity, as well as another scheme of what you call fund of funds up to 50,000. So I know the time limit, I have taken slightly higher. As far as one area I will cover, IBC, that the IBC has given a recovery of 46%. And even SARFAESI also has improved, RBI says. But and the period of recovery, even though there have been cases delayed and all, earlier it was 4 or 5 years of recovery, now has come to 1.6 years. Only thing is this 46% may be overwhelmed by some few accounts where you got substantial recovery. So with these things, I think our other experts will cover, and I will be open for further discussion later date. Thank you. Slightly I took, but I thought that overall perceptives will put to the our audience, and we'll again have a discussion on. Thank you very much.
Thank you very much. Wonderful issues. All critical issues raised. Wonderful. I think you have raised so many issues. There has to be a continuous series on financial and banking with so many developments. Wonderful. Everybody is waiting for the presentations. I believe all the panelists, they have joined. Shailesh, Ramesh?
Yes, Shailesh has also joined.
Yes, Manoj, yeah, I've joined.
Shailesh, just one word for you, from you on the overall finance and banking conclave, then from Ramesh and Mr. Rathi, then we start the presentation by Sanjeev Pandey ji. Everybody is looking forward to it.
Okay, thank you, Manoj ji. Wish my colleagues a very happy New Year. I must admit that participating in these knowledge series is truly enriching. I have had the opportunity to participate in quite a few of them. Manoj ji has been very instrumental. I'm sure there are other members, but I think there is a lot of hard work that goes on behind it. I look forward to sharing my experiences and learning from the experiences of other members. I think it's a great opportunity for people to share their views and learn from each other's experiences. I thank the Think Tank series, Manoj ji, and all the other members for this opportunity, and I look forward to hearing all members. Thank you.
Thank you so much. Mr. Ramesh?
Yeah, thank you, Manoj ji. A very good morning to all of you, and wishing you a very, very happy and prosperous and very safe 2021. Yeah, it has always been a pleasure to interact. We have had very informative sessions in the past few months. I think each session really enhances our knowledge, and we are much better off than as we go by every session. So today, I think, as many of you would know, that I have a credit ratings background. Like in the IBC case, when IBC was getting implemented, rating agencies were pulled in, saying that the company which goes into IBC also need to get it rated. Similarly, RBI has kind of brought in the role of rating agencies in this restructuring as well. As presently, I am not, earlier I was with CRISIL, so I had first-hand knowledge. But I have been interacting with my friends in the rating circle, both in CRISIL and in other agencies as well. So I have some interesting thoughts to share with you. So once I think the subject is introduced and other speakers have come, I have spoken, probably I would like to share my, whatever I understand, what's happening in the market regarding the restructuring, regarding the rating part of the restructuring. So eager to hear from all of you first. Thank you. Okay. Manoj, I think you're on mute.
Yeah, no. So now I would like to introduce Sanjeev Pandey, the speaker for the day. Sanjeev Pandey ji is the DGM handling NCLT at State Bank of India. He's been a stalwart in this area and has been providing a lot of good inputs on the subject. I would now request Sanjeev Pandey sir to share his screen and start up with this session and enlighten us with the knowledge what he has. Thanks a lot, sir. Welcome, sir.
Thank you. Thank you. I'll start with a happy new year to all of the participants, and thanks think tank team for having me here. How to share the screen? Can you just assist me?
So there's a share screen option at the down.
Okay. Yeah.
Next to chats.
Pandey, that there is a share screen with the some.
It will come in green. It will come in green button.
Yeah.
Yeah, green button.
Yes. Can you see the screen now?
It is visible now.
Okay. Thank you.
Very well.
Yeah. So, welcome all of you to this webinar on restructuring and NCLT. So, let me share a brief of my background. Like I had an opportunity to work with IBBI initially. So when IBBI was set up in December 2016, so I was one of the first, second or third employees after Dr. Sahu. And we were like very actively involved in the drafting of regulations. And I'll say that I was the organizer and the mover for the regulations on CRP, liquidation, voluntary liquidation, fast track, as well as information utility. So, of course, regulation have been having a lot of changes frequently, and even the code has got already 4 amendments. But I think code has been a paradigm change in the restructuring framework in India. Restructuring, as we can see, is as old as the credit. Like you can say default and restructuring come with credit. So I think the history of credit may go back to maybe a few thousand years. And default has happened as the credit has happened. And now restructuring is the part of like rescuing the credit without going whole into the recovery portion. So let me go briefly into the background of restructuring in India. So as we all know, the original Restructuring Act in India was the SICA Act, which was passed in 1985, and BFR was set up under that. And it worked for some time, but ultimately the people got smarter and they started using it as a sanctuary. Basic flaw with the BFR was that it provided an unlimited kind of moratorium. So whenever a company, which was an industrial company, and which lost 50% of the net worth and could file in the BFR for registration. And as we all know, most of us may be the chartered accountant, writing off or like reducing net worth can be due to a business problem, can be due to diversion also. So many companies landed in BFR deliberately by reducing their net worth. And ultimately they got an unlimited moratorium. So bank cannot take any action, any coercive action against the company. That was the predicament of BFR, which ultimately led to its withdrawal. Then came in 1993 the RDDB Act, or the Recovery of Debt Dues to Bank. This was again a very well drafted act, especially from the point of view of bankers. It came with strict timelines, but ultimately DRTs were set up, DRET was set up. It also failed to deliver because, again, the courts got bogged down in the processes of delays, and the people got smarter and they could go for forum shopping. Like if we go to DRT, bank go to DRT, they get us stay from High Court, and all those things happen. Ultimately, the condition of DRT Act today is that the average recovery from DRT, as per the recent RBI report on financial stability report, it is something like 3 to 5% over a period of 7 to 9 years. So that is the DRT or RDDB Act. So obviously it has not remained a very attractive act for the banks. Then in 2001 came the CDR, Corporate Debt Restructuring. So this was again a very good act. And here basically the major change which the government provided was that it was not exactly act, it was an informal or a formal arrangement under the RBI circular. So one CDR cell was created, and they were given the power to formalize a restructuring plan. And then if the 75% of the banks by value and 60% by number, they agree to the plan, restructuring plan. So it was implemented. This was a very good mechanism. It worked for some time. Many companies, if you, I don't know how many of you remember, SR Steel was initially restructured under this act, this mechanism. And even the Jindal Vijayanagar, SR Steel, many steel plants were revived because they were stuck in sometime in 2000, 2001, and they were revived due to this CDR mechanism. Many other companies also got revived. But ultimately, again, the bankers and the professional became adept at manipulating the mechanism, and it became more of a evergreen mechanism ultimately. So CDR also lost its this thing. I'll come to that again. Then came the SARFAESI Act in 2002. This was basically launched because banks were facing a lot of problem in recovering loans through the court process. So government came out with this very strong act, which gave the bankers some powers of the courts, basically to just give a notice and attach an asset and sell it in the market, which was very, very strong law. It was contested in the courts, and ultimately, due to one or two judgments from the Supreme Court and some changes, it lost its teeth. And today, the condition under SARFAESI is that when we take an account to SARFAESI, again from the RBI Financial Stability Report, the recovery from SARFAESI around 13 to 15% over a period of 3 to 5 years. Then came the RBI restructuring framework, which we call the GLF framework under the corrective action plan. Again, this was in 2014. This also worked for some time. Basically, this took care of the problem that bankers and other creditors were not coming together on a same platform. And hence, the promoters were taking advantage of multiple lenders. So the GLF put all the lenders on the same platform. But again, this also didn't work too well. And it also led to some delay in declaring the NPA. But nothing much came out of this. Then another scheme RBI tried was strategic debt restructuring, SDR scheme. In most of these schemes, as I see, is that the restructuring was never deep. And the tendency of the borrower was not to invest further money in his business, because many of the cases, the problem arises from the diversion of funds. And in some cases where there was genuine default, even I think many of the promoters were not sure that due to the existing lopsided capital structure of the company, they may be able to survive. And the bankers were more interested in not getting the account classified as NPA. So these schemes became a victim of this kind of thinking from both the borrower and the lender. SDR tried to give a deep restructuring by allowing up to 50% conversion of debt to equity, which was something new, because before that, bankers were not ready to take very big haircuts. So this scheme tried that. But due to this 51% conversion of to equity, different kind of problems started arising. I think many of you may remember that one case of one Calcutta company where the flyover fell during some 3 years back. And actually the bankers were holding 51% equity of that company. And that liability, because of the damage created due to that crash, came on to the bankers. So this led to another different kind of problems. RBI tried another scheme, sustainable S4A, we call it, scheme for sustainable structuring of stress assets. Here, the provision in the scheme was that at least 50% sustainable debt has to be sustained with the original repayment plan. So this was tried in some cases, again, not very successful. So ultimately, after learning from all these mistakes and all the experiences, court delays, the mechanism used by the banks to avoid NPA. So two things happened. In 2016, IBC was introduced. And RBI sometime in 2015 directed the banks that any kind of restructuring will not allow the account to be maintained as standard. So this was a paradigm change from the earlier restructuring. As I said earlier, the restructuring were being done just for the sake of maintaining the standard category, standard asset categorization of the account. They were not deep, neither the promoters were fully into it. They only just wanted that bank should give them some more money so they can manage for a few more years. Bankers were interested in just delaying the NPA. We call it, as you must be reading in many papers, as evergreening of accounts. So ultimately, RBI saw the red zone. They started one asset quality review of most of the banks. And they started looking at these assets with a microscope, and it came out that most of the accounts which were running as standard were actually deep NPAs. So RBI came out with this idea that, okay, you just for the sake of restructuring, you cannot do restructuring. You have to do either a deep restructuring, and once you do the restructuring, the account has to be classified as NPA. So this was one paradigm change which came in last 5 years. Second thing change was IBC. Then after IBC, again, a problem came that RBI came out with a list, as we call them, dirty dozen. So RBI came out with a list in June 2017. IBC was launched on 1st December 2016, and immediately the BFR was withdrawn. So that was again a very, very important date in the history of restructuring. The date IBC was launched. One major thing happened was BFR was withdrawn from same day, and all the liquidation and resolutions of a company were diverted to the IBC. And second change was that most of these other schemes like CDR, SDR, they were withdrawn. Actually, later on from the RBI circular date, but these were withdrawn. RBI came out with a circular in February 18. So RBI came out with a restructuring scheme. They call it resolution framework for stress assets. This circular said that in any account more than a certain amount, 2,000 crore, if the account is not restructured within, say, 6 months from the date of the circular, the bank has to compulsory go into the IBC process. So this started from, I think, 7th from February, and they gave time up to 31st December initially. But many of these cases were not able to be restructured, and these 12 cases which RBI came out in the first scheme, they were forced to be taken to NCLT after this period. Immediately after the period is over of this circular, they have to be taken to NCLT. Since most of these cases were already under severe stress, so banks filed NCLT cases, and these are some of the top-notch cases, including SR Steel, I think Bhushan Power and Steel, Bhushan Steel. So these have become the dirty dozen, and I think they have brought significant value to the IBC, significant learning to the code, and I think some historic judgments by even Supreme Court in establishing the code as a primary framework for restructuring. So today, as of today, as we see it, there are basically two kind of frameworks for restructuring, or we call it, the new name is resolution. So don't confuse between resolution and restructuring. Basically, resolution is a wider term which includes restructuring. Resolution can be by way of a OTS also. Resolution can be by way of any scheme which can cure a default can be called resolution. So resolution is the word given by IBC, and now we treat this word as the standard code for any restructuring. So now we have two type of setups available. One is the resolution under IBC, which is a legal format under Act of Parliament, and one is the resolution outside the IBC. So now today all these schemes of restructuring or resolution work under these two major mechanisms. So let me briefly discuss the resolution under IBC. So IBC, basically the initial trigger for the IBC process is default. As we see in the previous schemes, all other schemes, the trigger was NPA. It used to be NPA. And that was again a problem where most of the banks and the lenders were able to manipulate the date of NPA or even manipulate by not declaring the account as NPA for quite some time. So they will allow some enhanced limit, they will allow some temporary limits, they will push the borrower to bring some money from some other source. Ultimately, the approach was to delay the process of declaring the account as NPA. And second was that once it is declared NPA, then banks had the option of going to SURFACE and DRT. And then, of course, but what IBC changed is they removed this comfort. So now IBC says that a default is the trigger. Initially, the IBC came with the default of 1 lakh and more. But today, I think in March 2020, the government announced this limit of default, minimum default to 1 crore. So today, any bank or any lender, including an operational creditor, can take a company to IBC for start initiation of a corporate insolvency resolution process for a default of 1 crore and above. So two things changed here under IBC. One is that earlier in the all other schemes, especially the CDR, SDR, S4A, only the bankers, even SURFACE, DRT, only the bankers or the lenders who were defined under the Act as the lenders, they were able to approach the law. But now under IBC, even a non-banker, even ordinary vendor, an employee, anybody having a default of 1 crore and above can take the company to insolvency. So that is a major change under this law. Second major change is that in all the earlier schemes, including BFR, SDR, CDR, the control of the company remained with the borrower. So that was a big comfort for the promoters as they never lost the control of the assets. So they knew that even if the bank goes to the court, I have the control of the assets. So I can do whatever. And they knew that we can manipulate the court process. We can get it delayed like DRT. Normal average time is 7 to 9 years. And I think for any banker, at a rate of maybe 11 to 12% or 13%, the money may become less than 20% in 9 years or maybe 10%. So they knew that even after 9 years, if bank gets a decree from the court and they go to implement the decree, I may not have to pay more than 10% or 5% of the value. So that was a comfortable arrangement for the borrowers. But now with this IBC process, the moment a CIRP is admitted, the control of the company moves to an independent professional who is called a insolvency resolution professional under the law. The powers of the board and the board of the company is suspended. This gentleman, who is called an insolvency professional, takes over the control, the books of account and everything of the company. And he invites claims from all the creditors. He gives a public notice. After he receives the claims, he sorts the claim, he verifies the claims, and then comes out with two lists of creditors. One is the list of financial creditors. Financial creditors are those who have lent money on some time value of money, and a list of operational creditors, which is the any other creditor, like other than financial creditor, any other creditor who has, I think, maybe an employee, maybe a vendor, a supplier, an electricity company, a water supply company, any company who has supplied some goods or services to this company is treated as an operational creditor. So once the list is finalized, he files a copy of this list to the NCLT, and the list of financial creditors, he invites them to constitute a COC, which is called Committee of Creditors. In this committee, all financial creditors, irrespective of whether they are a secured creditor or an unsecured creditor, all are on the table. And this becomes a kind of the board of directors. So now in this arrangement, the control moves to the RP. He is answerable to NCLT and to COC. He has to maintain the value of the CD or corporate debtor as we call it here, during the currency of this CRP process. The timeline for completing the process is 180 days, which can be extended by another 90 days with a special petition to NCLT. And once the process starts, within 1 month of the initiation or commencement of CRP, the IRP is supposed or expected to constitute a COC consisting of all the financial creditors. This COC votes on multiple agendas, and the votes are decided on the basis of the exposure of each creditor. And this the exposure is decided on the basis of the claim filed by the creditor. And what is claim? Claim is the amount outstanding on the date of commencement of CRP. So if my account was NPA in 2017 and I started the CRP on 1st March 2020, so I will take that outstanding and the interest from that date, from date of NPA to the date of the commencement of CRP, I add both these things and then file a claim. And my voting share in the COC will be decided by total claims and my ratio of my claim to the total claim. That will be my share. So this is basically the structure of IBC. Now how it gets the restructuring. So now the IP prepares a statement of affairs of the company, which is called information memorandum, and he shares this memorandum with the COC, and then he goes to the market, makes a public notice that this is a asset, this is a company available for sale or for change of management, and if anybody is interested, they may bid for it. So he invites expression of interest. Once the market players come back with some expression of interest, he signs a non-disclosure agreement with them and shares the information memorandum. So each investor or each company who is interested in this will go through the IM, they will go make a visit to the company, they see the assets, they find out the market value of the company, and they will submit a RFRP, request for to the actual bid to the IRB. These bids are tested by the COC and the RP. One of the tests of eligibility is that the existing promoters cannot bid for their company unless they are a MSME category. So this was another major change which came in the IBC, which changed the rule of the game, because many of the defaulting borrowers, including some large ones, so they tried to manipulate the process. What they thought, that why not we bid our own company through this process and get my company back at maybe 20 or 30% of the exposure. So I'll be free from all the problem. But then I think government saw to this problem and they introduced section 29A, which barred the promoters whose accounts were NPA or who are willful defaulters. There are 1230 disqualifications. They cannot bid for their company. So this is the law. Then once the investor is convinced that it's a good proposal, he will submit a resolution plan. So coming back to restructuring, this resolution plan is actually the restructuring plan under IBC. The beauty or the originality of this resolution plan as against the restructuring plans or resolution plan under any other mechanism is that the IBC gives full freedom to COC to accept any kind of plan for the revival of this company or rescue of this company. So this includes maybe the conversion of 95% of the debt into equity, maybe writing off or taking a haircut of 90% or even 99% of the total exposure. So they can do anything. So there are no.
You are in, no?
Oh, no.
You are in?
I will unmute. Yeah.
No, you are in, no? Are you inside?
Yeah,
So-
sorry, Sanjeev. Yeah.
So basically, this is the kind of deep restructuring which was missing in all other schemes like BFR, CDR, where banks were reluctant to go for a big haircut or a deep restructuring which can actually revive the unit. So the focus was more on the protecting the account from getting NPA. Here it is an actual restructuring by two ways. First of all, banks are, as per the Act of Parliament and as this plan is approved by a court, so they are under no obligation to limit their discount or haircut to certain amount. So it can be anything which is viable and feasible. The plan has to be viable and feasible. So ultimately, any resolution plan which makes this CD work in future, this will be an acceptable plan. And another beauty of this, unless the banks or the COC are able to get a resolution plan within this 180 or 270 days, it has to go into a compulsory liquidation. So that is the Damocles sword hanging on the head, unless you decide quickly. Because under CDR, banks used to take months together, and some banks would still stay out, we will not approve. So there was no cram down. Here in this process, if the 66% of the COC approves any plan, there is a cram down proposal mechanism where it has to be accepted by all of them, including the dissenting creditors. It has to be accepted by everybody. That is one thing. And then it has, of course, taken the interest of all the stakeholders, including operational creditor, financial creditor. So IBC explains that resolution plan should have basic criteria where it should provide the liquidation value to the operational creditors, and dissenting creditors should be taken care of. So this is basically the restructuring under IBC. I think it has done wonderful job, especially to see the revival of companies like Bhushan Steel, which is like Tata BSL today. You see SR Steel, which is, I think, Nippon, AMC Nippon today. They are within 1 year of their change of management, they are into profits, they are running EBITDA. And we have been able to save a considerable number of jobs. And as Mr. Narendra shared initially, almost 20 to 22% of the cases which were referred to NCLT have been resolved through IBC, through CRP process, and we got a recovery of around 45 to 55%. For State Bank, it is more than 50%. So average recovery for industry is around 45%. So that is the resolution under IBC. Let me come to the resolution under the RBI framework. So RBI came out, as I said earlier, a framework in February 2018, but that was challenged in the court because the framework said that unless you decide on the restructuring resolution within 6 months, it has to be compulsory taken into IBC. So there, the court said that RBI cannot force a creditor to go to IBC. Basically, that was one flaw they found in the circular. And second thing, they said that the resolution has to be provided, some option to be provided outside the court. So basically, the RBI came out with a revised circular on June 7, 2019, where it fundamentally changed the structure by saying that, okay, now banks are free to take the company to IBC or not to take the company to IBC. Only they will have some disincentive by way of additional provision. If they don't take it to IBC, let them provide some additional provision, and we are okay with that. So the circular says that on the occurrence of default, one major change was again here, was that from previous schemes of NPA date, this moved to a default date as the date of trigger. So if in a consortium account, if there is a default with any of the bank, then that bank will notify all the banks. RBI has set up a mechanism where weekly level, all the defaults and all the status of accounts are reported to the RBI in respect of all accounts above 5 crore. So they come to know the default immediately. So within 30 days of the default occurring, all the member banks of the JLF or the funding banks, they will sit together and decide on a proposed resolution approach to this account. What do they want to do? Whether they want to go for a restructuring or they want to go for a resolution under IBC, or the promoter is coming back with the OTS so they can rectify the irregularity through OTS, or even rectification of irregularity also. These are all kind of resolution possible under the ICA framework. After the review period, if the banks are not able to decide within 30 days, then they have to immediately go to IBC or provide additional provision. But if they decide within 30 days, okay, we are going in for a resolution plan outside of IBC, they get another 6 month timeline to finalize the plan and implement the plan. So basically banks get 180 plus 30 days from the date of default to decide on a resolution plan. Then plan here also similar to IBC has to provide for payment of at least liquidation value to the dissenting creditors. Credit rating agencies, so bank has to go for a independent credit evaluation ICE through some approved credit rating agencies, and for up to 100 crore accounts, one IC rating is required. Above 100 crore, 2 ratings are required. And any delay in implementing a resolution plan will entail penal provisions. As I said, on the right side you can see post 210 days 20%, post 365 days another 15%, and total additional provision will be 35%. This is over and above the IRAC provision, which is provided as per aging of the account. Immediate upgradation of account is possible in case of change of ownership. So this is another new feature where in case the banks are able to find a buyer, investor in this company, and there is a change of management, then immediately the account can be upgraded to a standard category after restructuring. And if the restructuring is with the existing management, then there are certain conditions to be met before account can be upgraded. And that is the last condition. See, if satisfactory credit performance during the monitoring period. Monitoring period is again defined as something when 20% of the provision, the exposure is returned, and then only the account can be upgraded to the standard position. So these are further salient features of the scheme. Date of default is at day 30, end of review period, day 210, end of implementation period of resolution plan. Day 365, if the plan is not implemented, then penal provisions are attracted. Then end of monitoring period, upgradation to standard after 10% payment. So earlier in the previous circular it was 20%, now it is 10% of the total debt. It is not only the bank debt, it can be the debt including the NCDs or any outside debt also. So total 10% of the total debt should be repaid. Then only the account can be upgraded to standard category. And payment of 20% of the sum of account debt and or specified period. So the specified period stops with the payment of 20% of the total debt. So here, how we go about it, outline of ICA. Basically, we start with the lead lender who can appoint a process or resolution advisor to formulate a RP. So some consultancy firm or some resolution professional can be engaged who will prepare a resolution plan. They will sit with the promoter or the new investor and they'll prepare a resolution plan, and they'll come back to the JLF or the bankers consortium and they will show the plan. Then once the plan is approved by 75% by value and 60% by number, this plan again similar to IBC, it is a cram down provision is there. So it will be binding on all the lenders. So this is a good new provision. Then next problem could have been that any of the bankers during the formulation of plan can go to IBC just by breaking the ranks. So this mechanism provides a standstill clause in the ICA agreement. So this ICA is basically agreement, intercreditor agreement is signed by all the bankers within the first 30 days. And this standstill clause is there that no legal action, including proceeding under IBC by any lender during implementation of RP shall be done, and RP shall provide for payment of not less than liquidation value. Here RP is resolution plan. So not less than liquidation value to the dissenting lenders. This is a slightly tricky condition because then some of the lenders strategically try to dissent to get a better value, because the resolution plan can be valued less than the liquidation value. So they will get a minimum liquidation value. So that is one of the problem. But otherwise, this is the standstill clause, and resolution process can be terminated if approved by the majority lender. So anytime during this process or even after the resolution plan is approved, if a majority of the lenders think that plan is not being implemented properly, so it can be terminated by a majority of lenders. So restructuring options can be as under, these are the basic option in restructuring now. So I told you about two options. So under the this framework, either it can be rectification. So when there is a default, the promoter can come back and say that I can rectify the account within say 15 days or 20 days. And if he is able to remove the irregularity, then it is okay, and the account can go back to the standard asset category. Then debt restructuring. Here restructuring can be in two forms: sustainable debt and unsustainable debt. So the balance debt, unsustainable debt may have to be converted to convertible or optionally convertible instruments. They can be like of period up to say 20 years also. And sustainable debt is the debt which is based on the future cash flows, expected cash flows of the company during the repayment period, which have to be treated at a very, very conservative level. And all the debt that can be serviced through those cash flows, that is the sustainable debt. So basic debt is divided into these two parts, and unsustainable is converted into deep discount bond or convertible bond, optionally OCDs, which can carry an interest rate of maybe 0.1% or 1%. And basically they are not to be returned in maybe 10, 15, 20 years. Lastly, but not least, the one-time settlement. This can also be one of the resolution option. So as we can see below, elongated repayment schedule as per cash flows and economic life of the assets, reduction, step up of interest rate can happen, funding of overdue interest can happen. These are all the restructuring is normally done, that interest is carved out, overdue interest and interest during repayment period is carved out into a FITL. So this can be paid over 7 to 10 years. Working capital irregularity, like CC limit, if it is irregular, the regular portion is carved out into a working capital term loan, which is elongated repayment. So basically what is done is that only the sustainable part of debt is kept. Working capital limits, which are covered by the drawing power, they are only kept. All other are converted to a term loan. And then term loans are deferred to a period which are sustainable. Conversion of unsustainable debt into convertible, optionally convert debt. Direct conversion to equity preference share is also possible, and additional priority debt on selective basis. So that is one more provision which is new to IBC as well as RBI framework. Earlier, the bankers were not very comfortable in giving any further money to the defaulting borrower. But under this scheme, the banks can give additional funds, and which will stay as a standard asset, because earlier the concern was that if I give additional money, one, it will be putting good money after bad money, and second, it will become more NPA. So if I have 100 rupees already NPA and I give more 20 rupees, so I have 120 rupee NPA on my books. But as per the RBI scheme, this framework, as well as IBC, any additional limit given to the company to sustain operations is treated as interim finance or additional finance, and that can remain standard during the implementation of the plan. Now let me come briefly to the RBI framework under COVID. So as RBI framework was already active, due to COVID, sudden pressure came on the economy and all the borrowers. So RBI said, okay, we have to come out with a special framework for revival. So they provided a window under the prudential framework for revival of real sector activities, and only to the borrowers who were impacted by COVID-19. So why was it required? First, financial stress because of COVID, impacting the long-term viability of many firms, otherwise having a good track record. So these companies were originally viable, but because of the forced lockdown, they lost the viability and they had to be brought into a viable category again. Debt burden of borrowers becoming disproportionate as the cash flows stopped suddenly and the interest kept on applying. So the debt repayment capacity of the borrowers was distorted. So this was another reason. And such widespread impact could pair the entire recovery process. So basically it was not only one company, it was the entire ecosystem which was disturbed. So that's why this COVID framework was required. Key features are facilities extended only to the borrowers having a stress on account of COVID. Enables lending institution to implement resolution plan without change of ownership while classifying the account as standard. So this is a fundamental difference between the RBI framework and the COVID framework. Here, without change of management, if we do some kind of restructuring or some resolution under the COVID framework, even with the existing management, the account can remain standard. So this circular of RBI is to be read in conjunction with RBI circulars like June 15, IRAC norm circular, Prudential framework circular, then March 27 COVID regulatory package, and COVID-19 April regulatory package. So these are all to be read together with this COVID framework. Eligibility and applicability, eligible to all lending institutions in like commercial banks, urban cooperative banks, state cooperative banks, all India financial institutions, all non-banking finance companies, including housing finance companies. These are all covered under this framework. It is not borrowers, not eligible are these SME borrowers, farm credit, financial service providers, loan for on lending, exposure to central state government, local government, housing finance companies where account has been rescheduled. So these are not covered under this framework. Borrowers eligible for our resolution plan under this circular are basically accounts which were classified as standard but not in default for more than 30 days with any lending institution as on 1st March 2020. So that means any account which was not in default from 1st February or maybe 29 January, up to not more than 30 days of default as on March 1, they can be covered. Plus account should be continued to remain standard till the date of invocation. So it should not have turned into an NPA category. So 90 days should not have passed from the date of default, and the stress should be on account of COVID. Guidelines for borrowers other than the personal loans are basically these. So guidance for invoking RP. So basically the borrower has to approach the bank by invoking the resolution mechanism. He may submit a request for invoking RP under the circular. So if there is a single lending institution, decision is taken as per the board approved policy. So banks have been asked to prepare policies for this kind of this COVID framework. If with multiple lending, then it is to be under the ICA framework. As I said, 75% value, 60% by number. The resolution under this framework may be invoked no later than 31st December 2020. The resolution must be implemented within 180 days from the date of invocation. For the ICA framework, it can be used, timeline is to be signed within 30 days from the date of invocation. So as against the date of default, here the ICA can be signed within 30 days from date of invocation. Failure to sign as ICA within 30 days, invocation shall lapse if the ICA is not signed 30 days and the lender is given at least 75% by value and 60% by number, they don't approve, then this will lapse. And then this framework cannot be invoked. Lenders other than a specified lending institution and dispute redressal, they can also join this ICA, like the mutual funds, the bond trustees, they can also join the ICA in invoking this framework. Key features of resolution plan, basically additional facilities can be provided to address the financial stress. Interim finance may also be provided, which will remain standard. Tenor can be extended of the loan, so reschedule and given further time for repayment. Credit rating is required if exposure is 100 crore above. Conversion debt to equity is possible, and valuation to be done as per IRAC norms, and conversion to any other security other than equity or NCD will be valued at ₹1. Asset classification provisioning. So under this framework, upgraded to standard asset or maintained as standard asset based on the time-bound implementation of the plan. Additional finance as well as the restructured debt to be treated as standard asset only if resolution plan implemented within stipulated timelines. If not implemented within the timeline, additional finance would be classified as per actual performance toward additional finance. So provisioning and reversal, provisioning held by ICA lenders shall be as per the extent IRAC norms before implementation or 10% of the total debt, whichever is higher. So here there is a provision of two provisions, like either it will be as per IRAC norms or 10% of total debt. So if, next is non-ICA lender immediately upon 30 days from invocation to provide 20% provision. as per IRAC norms. Provision required to be made as part of RBI COVID-19 package may be utilized for meeting the provision requirement. So any other provision made as per RBI COVID-19 regulatory package can also be used for purpose of this provision. Reverse half of the provision upon payment of 20% of the residual debt. So this is basically the specified period. If the 20% of the debt is paid and remaining half upon payment of additional 10% of the debt, then the additional provision can be written back. Default post implementation, in case there is a default post implementation, then any default during monitoring period shall trigger a review period of another 30 days. If borrower continues to be default post end of review period with any lender, account shall be downgraded to NPA for all lenders from the date of implementation of RP. Further upgradation possible only post restructuring as per prudential framework. So once there is a default under the resolution plan under this framework and it is not treated within the 30 days, then any upgradation is possible. The bank has to go back to the RBI resolution framework and post restructuring only will be possible. So again, there is one more this thing. The RBI constituted a committee for different industries to provide some guidance for particular industries. And this committee was headed by Mr. K.V. Kamath, ex-ICICI Bank chairman, and Divakar Gupta, Ashwin Parekh, T.N. Manoharan. And the RBI said that the compensation, the EC shall have its secretariat at the IBA. Expenses compensation shall be borne by RBI. And they were supposed to notify the parameters. And they will do the vetting of the resolution plans. So this framework, this committee is already in existence. They are working on the plans. And they have provided some indications like this. They have said that basically 5 ratios, they are providing guidance on these. These are total outside liability to adjusted TNW, total debt to EBITDA, current ratio, debt service coverage ratio, and average debt service coverage ratio. These are the 5 ratios on which they are providing the standard parameters. And this slide shows what are the parameters suggested by this committee. As you can see, for different industries, they have provided different parameters. Some industry, I think recently the aviation industry has come back to the government that they want some relaxation in these parameters. But as on date, these are the parameters suggested by the committee. Another consideration for implementing the RP, that graded approach of COVID-19 impact, lenders may adopt a graded approach toward preparing and implementing RP. Such graded approach may entail classification of impact on borrowers, mild, moderate, severe. So these are all guidance for formulating internal policies for the banks. Then ICA and escrow compliance, signing of ICA within 30 days is mandatory. Escrow account may be maintained at the project SPV level. So for a company with multiple SPVs, different escrows can be maintained. Compliance shall be assessed for lending institution as part of supervisory review. Ratios will be monitored, compliance to be monitored on ongoing basis. Any such breach not rectified within a reasonable period to be considered a financial difficulty. TOL, TNW to be maintained on the date of implementation as well as till March 31, 2020. So this ratio is very, very crucial. This has to be maintained up to 22. All other ratios shall be maintained as per RP by March 31, 2022 and on an ongoing basis thereafter. And it further says that studies to be conducted before RP implementation wherever possible. So there has to be a valuation report from 1 or 2 valuers. A techno-economic viability study has to be conducted. Stock and receivable audit has to be conducted. And ICE, independent credit evaluation from an external CRA, has to be got for account more than 100 crores. So now this is the comparison between the two framework, like RBI framework and the COVID regulatory framework. So basically you see the reference that in the RBI framework, default, then commencement of review period, resolution or recovery is possible. Resolution process to be completed within 180 days. If implemented, then monitoring period starts. and after monitoring period, 20% of debt repaid or 10% of total debt repaid, upgrade of account. And if not implemented, it will become an NPA and the process will start accordingly. Under COVID-19 default, basically the default has to be caused by the COVID-19 fallout. If yes, then relaxation can be provided as outlined in the COVID-19 regulatory framework. Default in this case shall not be considered as financial difficulty as defined in the RBI circular of prudential framework for that is June 7, 19 circular. Relief is specifically to tide over the economic fallout of COVID-19. So these are the basic difference between the two frameworks. Income recognition will apply this 15 circular of RBI will apply as it is, and the provisioning requirement are shown here. So now let us see what will be the impact of this situation on the IBC cases. So basically the problem which has happened because of the change of the limit from 1 lakh to 1 crore, consider view is that the 1 crore limit applies only to for prospective filings. So now some of the clarification has come from the NCLTs that the cases filed before this change or the default which have happened before this date of notification, and the application has been filed in NCLT already but not yet admitted, there this change will not apply. So basically if a petition was filed sometime in February and the default was less than 1 crore, that will sustain, that application will sustain. Seeing many situations where factories or other lockdown or operating at a minimum staff and going through the business continuing planning, value preservation is a challenge here. Because in many cases, the CRPs were delayed due to the closure of NCLTs and the deferment of the 180-day process. So we are seeing some challenges. Then there is a problem of many of the resolution applicant backing out, who have already filed a plan. Plans are before NCLTs for consideration. Now because of COVID, they see that the valuations have gone down, so they are slightly backing out. That is another problem banks are facing under IBC. So this is all on restructuring. I think briefly I'll cover pre-pack. If given, do I have time for this? Sandeep ji?
Yes, we can actually take some questions. And
Okay.
By the way, I should thank you, Pandeyji. Your presentation has been very good. Everyone has been appreciating, and the way the clarity what you have brought out on the discussion has been pretty good. Well, we can have some questions which have been coming over.
Okay.
1 second now. One minute, sir. Sir, there one question from Mr. Prakash Agarwal, where he talked about what happens in case the borrower is in regular payment, but ratios are not maintained by the person.
Come again?
We have situations where we will not able to maintain the ratios.
So, come again, promoter is in regular payment.
What happens in case the borrower is in regular payment,
okay,
but the ratios are not maintained? You have specified certain ratios, the 5 ratios, what you are talking
about. So basically, if you see, we call it a technical default. If ratios are not compliant,
okay,
but there is no default in the account. So as I understand, there is no default here, only a technical default because of the subcovenants of ratios. So I think India, we don't treat them as a default as of now, as per the framework or IBC. As of now, it is only a actual default of repayment that is considered for initiation of. So technical default is as yet not a default.
Okay.
So the account will remain standard.
No account will stand. Okay. Can I request Rathi ji to take it up, please? BS Rathi ji.
Thank you, Sandeep. Thank you. So after Sanjeev ji has given a wonderful presentation, I don't think much is left to speak. He has covered almost every element of restructuring and IBC. A couple of points that we have not seen any great response to COVID restructuring scheme of RBI. So one of the reason which we have realized is that the RBI, this expert committee norms, which have been specified, are little tough for corporate to for achieve. We had one question also that if account is regular but ratios are not being met. So that type of situation we have seen in many cases. One of the requirement is that EBITDA ratio should be 5 times, EBITDA should be minimum five, the total loan outstanding should be minimum of 5 times of EBITDA. So particularly these sectors which have faced the problems like hotels and tourism, so there getting this 5 ratio is very difficult. Nobody works on that type of ratio. And second thing is March 22, the committee suggested that these ratios to be achieved by March 23, but RBI has preponed it to March 22. So that is one thing which has created issue, and that's why so not many companies have gone for this. The second point is that even though the account remains standard, the banks have to provide 10%, and in many cases banks have been reluctant to consider restructuring. Rather, they have suggested that we will give some short-term funding, additional funding, instead of doing this restructuring. So that's why we have seen that this scheme has not been that popular. Fortunately, economy has picked up very well. Those who were having problems prior to COVID, they will continue to have problem, but the fresh cases have not been that much. In fact, even the hotel industry is also looking up. Yesterday only I was reading the newspaper that all the hotels in North India, Manali and other places are having 100% occupancy. So hopefully these sectors will also sail through, pass through. The problem is for the companies which were facing problem prior to COVID. So for that, there was a demand that RBI gave some relaxation. See, prior to 2015, Mr. Pandey will vouch that prior to 2015, one time restructuring was allowed without account getting downgraded to NPA. But RBI said, Mr. Raghuram Rajan was the main person who was instrumental in getting this policy. He said that there is no point in pretending that you are good and healthy. If you are not, you admit it. Let account be NPA upon restructuring. And once it is crosses 1 year of satisfactory performance, you will be again upgraded. What is the problem in making it NPA? But the problem was that banks had capital issues. They didn't want account to be made NPA. And so many cases are there where banks didn't do restructuring in time, and the problems compounded. And today, that is one of the reasons that we are seeing so many cases under IBC. So this is all I wanted to say in a brief time I am allowed.
Thank you very much. Wonderful insights. I would just like to add, Mr. Pandeyji, we have discussed at length about IBC and also the transparency which bids are invited and should be invited. So there is equal opportunity to all the bidders to participate in the India growth story. I would like to share particularly transparency issues. I had an extensive interaction with the MD of Tata Steel and CFO of Tata Steel in respect of their bids for Bhushan Steel, which has been among the largest cases. Particularly for bankers, it was a very good experience story. But in respect to transparency, lot of pains were taken by Tata Steel management, the CEO and the CFO, Mr. Narendra and Mr. Kaushik Chatterjee, and explaining how it was a good acquisition, about the cash flows, and about the additional capex being done also. The company was willing to put additional capex to make it a very globally competitive company in terms of EBITDA per ton and cost per ton. But we find this is missing from many other promoters. We have been talking about the corporate series, the good, the bad, and the ugly. What can be done to ensure highest level of transparency so that we get the best bids, bankers have the maximum advantage, and also all the stakeholders, they know that it can be a very good story and maximum value addition and unlocking the value in the corporates which are now going for restructuring or IBC for whatever reasons. There are multiple reasons. Mr. Pandeyji, your expert insights on these issues, and I know you have always advocated for highest transparency.
Yes. So basically, I think transparency is inbuilt into the IBC framework. So it starts with the public announcement of the insolvency process. Everybody knows. It's not that only few people know that insolvency, the company has gone into insolvency. So it's a transparent process. Every creditor in the market, if he makes an effort to go through the classified ads, because many times we see that people miss this advertisement of insolvency announcement, but everybody knows that is the start of transparency. Then the selection of RP itself is through bid process. So we in State Bank, we invite the RPs to take over the transaction through open bidding, which is offered to maybe 100, 200 IPs at that particular center. So that is again a transparent process. The entire marks are given for different credits, and then best person is selected. Then comes the EOI process. It is very transparent. Advertisement is given in one national daily and a local daily. Then IM is available to all who are able to sign the NDA with the RP. And for both the COC and as well as the investor, they can ask for any information from the RP. So as per law, they are entitled to get any information. Of course, other than some trade secrets, which the RP will not disclose in the process, other than trade secrets or some key information, RP is able to show around and show the information to the bidders, and COC can demand any information. So I feel that this entire process is built into a transparent process. Maybe going forward, if we go for the pre-pack kind of a situation where the banks go with a pre-packaged plan to NCLT, I think there will be some challenges of transparency, because we will be dealing with one particular investor who will come back with a ready plan. Bankers will discuss that plan, approve that plan, and then the petition will be filed with NCLT for the approval of the plan. It is a kind of shortcut process, which has its advantages. One of the biggest advantages that we know we have a resolution in hand. Otherwise, when we go to CARP, the major challenge is that on that particular date, when we file a petition, or when it is admitted, nobody knows whether a resolution plan will come or not. Only thing certain is that the company may land into liquidation. That is the big uncertainty in this process. But if we have a pre-pack kind of a thing, we will have a certain plan in hand before we go to NCLT, but at the cost of some transparency. So my take is that the process is very transparent, including the RBI framework also, because it is a common forum. JLF sits on the plan. They sign an agreement. All the information is shared. A statement of affairs is developed, and it is shared with everybody. So I think what IBC has done is bring a lot of transparency in the process. I always say that earlier the bank NPAs were only known to the bankers or the borrowers. As we all know, I knew my bank is holding so much NPA, which account is NPA. Market never knew. But today, after the introduction of IBC, every person on the street knows that SR Steel is in insolvency. SR Steel was sold for so much. It is there in the next day's newspaper. Okay, Bhushan Steel banker had to suffer this much haircut. Even in Alok Industries, the haircut was more than 80%. Everybody knows in the market. So that is the transparency which has been brought in by the IBC, and I think which is good for the system, because we cannot hide behind certain curtains. Everybody is exposed, not the defaulters. Defaulters are exposed in the market. Even bankers, our balance sheet is exposed to the market today. My accounts are exposed to the market. So this is good for the credit market.
Thank you very much. And it's glad we are having a lot of real life example. Shailesh, can you add your thoughts on transparency issues, and then we'll have excellent insights on restructuring from you.
Yeah, thank you, Manojji. And I fully subscribe to, I think, Pandeyji's thoughts. I think one, we are in a much better world in terms of data availability and resolution in today's world as compared to what we were, let's say, 5-6 years back. The IBC has been a great enabler for banks. It's a great tool which banks can use to sort of look forward for a suitable resolution. Even outside IBC, the framework that RBI, etc., have given to bankers enables decision making within banks, because I think what was lacking a couple of years back was basically a time bound resolution process and the enabling sort of enablers from an enabling framework to sort of aid in decision making. Now I think both of those have been provided. We are seeing a lot of resolution in the market and a very suitable resolutions. Yes, COVID has impacted, and things are very, very busy for everyone right now, because yes, there is some real stress in the economy, some due to COVID, some outside COVID, and we have to be careful to sort of navigate through this downturn, so to say, and come out. Banks have a vital role to play, and we are doing our best. And hopefully we will come out of this all together in good shape.
Thanks, Shailesh. Let's have the presentation slide. We can have be in the presentation mode.
I'll just make one comment before you go to the next presentation, which I think I missed in my presentation, is that this RBI framework, basically the template is IBC only. So if you see deeply into this RBI framework, it is exactly a copy of the IBC framework into outside of the court process. So the process is controlled by a team of bankers, the GLF. That is the only difference. Otherwise, if you see the 6-month period, the protection of dissident, so most of the ideas are picked up from the IBC. The only thing that will help you in understanding the framework better. Thank you.
1 minute, Sanjeev Pandey.
Yes.
That June 7th, 2019 circular, in the beginning that paper reports know that before March that time, a lot of proposal could not be completed due to the inter-C agreement and all.
Yes.
Are you finding now such of those assets which are not affected by the COVID or legacy, other than the IBC? Are we getting a good response in that circular one? That is the one issue. And whether the overall resolution taking place in that category. And of course, that is now known that under the latest circular on COVID assets also, all I have mentioned, the paper report we find that people are not availing this resolution. Now that Kamath committee, that prescription and all, can it be little more practical, or of course we cannot comment on that, but I think it is a little expecting that time that the COVID we would get in over the COVID much faster. Now that has really taken more than a year, and it is still taking another 6 months. So the 2 years moratorium and getting into that ratio by that time may be slightly difficult. So maybe the Reserve Bank and the committee, or with the representation of the IBA and all, provided we have a lot of requests. But if there is no request, then naturally they have taken care elsewhere with the capital raising and all. So that may not be necessary. This is the other one comment. But that RBI circular, how, because that is the only one outside the IBC, now it's available. So how are the bankers taking interest, or how that is practicable, and how the response has been coming?
So initially we had some challenge in the IC arrangement. Basically, IC arrangement is coming out of this RBI circular. So initially there was no cram down kind of a provision. So even if 10% of the creditors are not agreeing to a resolution plan, then the plan was stuck. But now with this 60 and 75% condition, there is a kind of cram down here. So once the 75% by value and 60% by number, they approve the plan. So all have to, it is binding on all. That is one good thing which has the later development in circular. So this is a good thing. And we are seeing, I think, around 100 plus cases, ICA is being currently implemented. So 100 plus cases. And there are some 10 or 15 success stories already. We have been able to sell some assets under change of management. One was recently, I think we sold a large power plant to NTPC at a very good value, just at, I think, 50% haircut or something. So there are successes, but and still in many cases ICAs are going on. So ultimately now we have a bouquet of solutions actually, if you look at it. So we have ICA, we have IBC, then we have 230, section 230 kind of a arrangement. So we have multiple options. So it is for the borrower and the banks to make use of the best thing which is applicable to them. Coming back to the ratios prescribed by the committee, I think this is something like one size fits all. That is difficult to apply for business. No? Every company is unique. It has its unique capital structure. It has its unique success points. So that is a bit of a challenge. But I see it as like we have multiple options now. So it is for the borrower and the bank to see the best option.
There is a question from Kamlesh Taneja. He has raised his hand. Can I request Kamlesh to ask his question, if any? Kamlesh?
Good afternoon, sir. Your presentation was excellent and most of the points were covered. I have only one issue which I want to clarify. It was informed that this resolution will be implemented if 75% by value and 60% by number is agreeable.
Yes.
And the one more issue is that if one of the bank makes the account NPA, then all of the other banks has to make that account NPA after resolution.
Yes.
As of today, because of the Supreme Court order, all accounts are PA. And once that resolution is agreeable and the bank which is rigid or which doesn't want to make that account PA, even after Supreme Court order, so then all the bank necessarily has to make that account NPA even after resolution.
Yes, yes, that is the
So there is no solution if that bank has not participated in the resolution process, but he was forced to give the money and he is not making the account PA, then all other banks who have given the money, they are bound to make it NPA.
Yes,
so
but
no solution.
Once the plan is approved, it is binding on all the banks.
That's okay. But up to that stage is not an issue.
Second thing is the bank normally will not make the account NPA. I think the borrower makes the account NPA. No bank is interested in making the account NPA.
No, there are two, three accounts. I should not name that where one or two bank has taken. They have a smaller exposure, say 2 or 3%, and they have taken a resistance. You either pay the money or we will keep the account as NPA even after this resolution. So, what is the solution for bigger bank who have the bigger exposure in that?
I think solution is the negotiation, bring them on the table because.
Okay.
And I think I agree with you. Some of the ICAs are stuck on this point. Okay. One or two banks are stuck, maybe having 2% share. We are holding on to this thing. That is still a challenge.
That is a challenge. Okay, sir. Thank you. Thank you for your information. Thank you, sir.
There's again Mr. BD who has raised his hand. If he has any specific question.
Yes, sir. A specific question is there, sir. Good afternoon. A very good presentation. Sir, I have a question. If a company is discounting its sales bills with a factoring company.
Hello. Request everybody must put the video on when coming on screen. It's a request for everybody.
Okay. Yes, sir. Sir, I have a question. A factoring NBFC company or subsidiary of a public sector bank is discounting the sales bills of a company. Now there are delays in paying those sales bills which are factored. Will that factoring NBFC can be a part of this restructuring exercise?
Yes.
They can be.
Can be.
They are saying neither we are working capital banker nor we are term lender. We are a NBFC. This is only a sales bill discounting facility, and therefore they are saying that we cannot be part of this restructuring.
I think it depends on now the mutual funds have been allowed to participate in the ICA. The SEBI has allowed some companies to participate in ICA. So it again depends on like how their sector regulator has allowed them or not. So I think NBFC is being controlled by the RBI. I don't see any problem in participating.
So just a clarification, mutual funds, those who are permitted to be part of this must be in respect of their term lending to the companies, right?
Yes.
So now this NBFC says that we are neither a term lender nor a working capital consultant banker. We are just factoring your bills against your receivables, and therefore
lender हो गया ना, receivable का case करना है तो they have to fall in one category. They are a lender. Only thing they have to see if they are lender to whom, the buyer or the supplier. If they are the lender to the supplier, then if supplier goes to restructuring, they are one of the lenders. They have exposure one place, no?
Yeah.
So they have to see where they fall, but ultimately they have lent money, so they are the lenders.
All lending institution, actually, as per the circular. So, including whether if it is a housing finance company also, if it is NBFC, all are part of that. They have to know.
Yes.
And only, of course, some mutual funds and all, if they are coming out of the RBI guideline by some other regulator, but they also have to come in line if they want to be part of this.
they are saying, so just a small addition, they are saying that they have obtained some clarification from RBI, and RBI has informed them that they cannot be part of restructuring.
If he is a lending institution, he is a part of that and coming under the RBI supervision. But if he is not a lending institution, some other then that is different.
Yeah, so
am I right, Pandey ji? Abhi ka direct में all lending institution लिखा है ना?
All lending institutions here, NBFC,
lending institution है.
Cooperative banks.
And उन्होंने आपने RBI circular देखिए उसमें क्या-क्या institution आता है वो भी दिया है.
Ready to speak, no?
That has to be gone through. And if they are something different, then they can show you that clarification they have obtained. But otherwise, if they want to be part of the resolution, they have to be there.
Yes.
Okay. Yeah. Thanks a lot, sir. Many thanks, sir.
We have many questions coming in, but actually we have to continue ahead with the next presentation. I would like to Mr. Shailesh to share his part of the restructuring process.
Sir, can I ask one more question?
One second. We'll have an open house from all perspectives: the borrower's perspective, lender's perspective, stakeholders' perspective, foreign investors' perspective, and government perspective also. Lots of real life issues. Let's have the presentation and hear insights with a lot of data points from Shailesh, and all the panelists would be here and lots of participants. Let's be ready with a healthy, positive, live interaction, all perspective integrated with the capital markets. We have seen a lot of fundraisings now, even by PSU companies, Can Bank, IDBI Bank, PNB, and earlier by private banks. So lots of practical issues are there with full integration, all perspectives. Shailesh, everybody is waiting for you.
Yes, Manoj, thank you. Am I audible?
Yes.
Yeah, you're audible.
Okay.
Yes, Shailesh, continue, please.
I have put my screen on screen share. Is the PPT? Can people see the PPT?
Not yet. Not yet, Shailesh.
Okay. Just 1 minute. I don't know if there's some issue because I have put my thing on screen share and
Meanwhile, can I ask a question? If
I will have questions later.
Okay.
The digital team is working on the presentation, and it is being onboarded immediately. Aditya, you can help?
Yeah, Shailesh, can you try it once again? Because I tried to share this. There was nothing stopping me to share. So there is nothing being shared from your end. You were sharing it initially.
Aditya, you can share it if it is available with you. And
no, I'll do it. I have it over. I'll share it. Just 1 second. Shailesh, I'll just do it. Shailesh, is this right?
Just one.
All the
Shailesh?
panelists have worked very hard to have a lot of data points.
That's
And
correct.
about
Yeah.
the India growth story, it's very vital. The trends, the graphs, the data, it's very vital for all the professionals and all the bankers. Wonderful.
Okay, great.
Shailesh,
I think.
I'll take to the next one.
Okay, great. Thanks, everybody. Thank you, everybody. Thank you, Pandeyji, for a great presentation. I will start immediately with my presentation. The mandate to me, and the agenda that was basically set out for me was basically talking about the management and resolution of stressed assets, excluding IBC and the RBI framework of the June 7th circular and the August 6th circular, which Pandeyji has so elaborately covered. I want to basically touch upon some of the other avenues that may be available to bankers, because these are something that we deal with on a day in and day out basis. I think just to put things into context, I think one must realize that lending money is, in my view, I think slightly easier in terms of, but when it comes to recovering money, it is a very difficult conversation to have with promoters, whether they have the intent to repay or not. I think before IBC, before these frameworks, it was very difficult to even get meetings with promoters, because once they're in default, they would refuse to meet bankers who are chasing them for money. Now that IBC etc. is there is a risk of time-bound resolution and they're losing the company etc. So at least they are meeting. But when you go and meet them, the first thing they say is that yes, we want to repay you, but we have no cash flows. So I think the conversation that you are trying to recover money starts and ends over there. And we as a banker will have to think about other ways in which how we can sort of create a win-win situation and get our money out. So I would just like to touch upon some of the avenues that are available generally for management and resolution. And the idea is to keep it a short 10 to 12 minute presentation, and I will try to stick within the timelines. Just to put things into perspective, what we are, where we are today, if you look at basically the closing balance as of March 20, we are looking at almost 9 lakh crore of gross NPAs which are sitting within the banking system. That's almost 9% of the total advances. So obviously it's a huge number. If you look at the slippages, again, that number is, it had spiked around March 17, March 18. Next slide, please. If you look at the slippage ratio, it had spiked in March 17, March 18. It is sort of lower than where we were, but it is still, about 4 to 5%. But that itself is a huge number where we are seeing the number of slippages in the market. Next slide, please. If we look at the trends in which how these assets have been resolved, yes, it's very easy for a bank to find a ARC to sort of take over the asset, subject to suitable commercial price, etc. But if you look at the graph on the left hand side, it does talk about that the book value of assets acquired has increased, as well as the acquisition cost which has been paid by ARCs has increased. But that translates into the graph on the right hand side, because the acquisition cost for ARCs is increasing, the number of deals which have been closed in the market is basically going down over the years. So that basically means that banks have to resolve their own stressed asset issues, and the opportunities in the market to sort of sell it down, etc., are limited. I'm not saying it's not there, but it's limited. Moving on, this I think is a very important sort of slide, because early warning signals is where the problem starts. Yes, banks do get an indication that yes, there is a problem, but the magnitude of the problem is often not known. If banks, the credit committees, and everybody involved in the loan dispersal and the monitoring process is able to get these right, then I think there is definitely going to be a lesser NPA problem. There is no science to it. It comes with experience, and every case is different, so there is no fit formula. But early warning signals is perhaps the most important aspect of management of stressed assets. We are all aware of what the early warning signals could be, days past due in terms of SMA 1-2 reporting, longer debtor inventory days, leverage ratios, fallen margins, devolvement of LCs, BGs. All of these are some of the early warning signals, and it is very imperative that banks look out for these early warning signals. In my view, once the early warning signals sort of have stabilized and we see that the company is or has been in stress, in my view, it is at this stage that the forensic audit, etc., should be initiated. Because typically what we have seen is that early warning signals happened, have occurred, the company has been in stress for 1 year, 2 years, etc. Then there is an RBI, like a trigger under the RBI framework or IBC, etc., where a forensic audit or a transaction audit is initiated. By that time, we are already about 3 years post the problem, when the actual cash flows issues have started. And if there is a diversion which has taken place, it's perhaps too late to sort of get that money back, because the diversion has already happened. You are already 3 years post that time period. The promoter has taken out whatever he wants to take out, and now even if he loses the company under IBC, etc., he's not that much bothered. So if you get the early warning signals right, and if you do the forensic at the correct time, I think they are great enablers to get the company back on track. Next slide. What exactly is restructuring? Restructuring is nothing but an act by the lender for economic or legal reasons to offer concessions to the borrower from your existing terms and conditions. It could involve reevaluating cash flows, increasing, decreasing the rate, taking additional security, promoter guarantees, reschedulement of ECBs with under regulatory approvals, revised documentation, all of that. So all of this comes within the ambit of restructuring. There have been cases where we have seen, for failed restructurings where the promoter, etc., restructuring was agreed. Promoter basically was able to get in the necessary funds within the specified timelines. But for some reason, the banks, I think, were not able to deliver on their promises or their, on the restructuring proposal for whatever reason. I don't know whether right or wrong, but for some reason they were not able to deliver, and the company then basically headed to liquidation. So not only did the banks lose money, the promoter who basically stepped up and put in money for a restructuring, he also lost his entire money. So that was clearly a lot of value that was lost in the process. Framework I will not touch upon because this has been extensively dealt with in the previous session. So June 7th and August 6th, I will not touch upon. What I want to basically touch upon is emergency credit line. This is an RBI sort of RBI/Government of India initiative to correct COVID-related issues. So borrowers who are standard, and this is, I'm talking about emergency credit line 2.0, because I think before this there was ECL 1.0, etc. So under ECL 2.0, borrowers who were standard as of 29th Feb 2020 with less than 30 days of past due and debt which is between 50 crores and 500 crores are eligible for 20% of their exposure to be disbursed by banks under the emergency credit line. Now, this emergency credit line from a bank's perspective is guaranteed by the Government of India, and it has certain RWA benefits. That means the risk-weighted assets that the bank holds for the asset that it has lent out or the money that it has lent out, there are certain RWA benefits. Also, you are moving away from the credit risk of the corporate to a Government of India credit risk, which is obviously better. The broad frameworks is, the broad contours of the deal are that 75%, in case the loan goes bad, then 75% of this amount will be repaid within 30 days of the claim by the bank, and 25% on the conclusion of the enforcement of proceedings. The interest rate is capped at 9.25 and the tenor is 5 years, which includes a 1-year moratorium. The existing security, etc., is sort of extended to this loan, and we are seeing this is basically available to those companies who have faced stress due to COVID, and there is a lot of demand for this kind of emergency credit line. We are seeing a lot of corporates who are basically taking this, taking effect or taking benefit of this initiative by RBI/Government of India. What we understand is that the total corpus allocated under ECL was 3 lakh crores, of which the last update that we had was that almost 260 to 270,000 crores was already blocked, because I think once the bank agrees to give this additional funding, they have to immediately go to a particular website and block their particular amount, that this is the amount that we are proposing to disburse under ECL. And that amount currently stands blocked at almost 80 to 90% of the originally envisaged amount. So this scheme has evolved over the last couple of months. This is where we are today in terms of ECL 2.0. One-time settlement. So now we're obviously coming to the various options that are available outside the framework and outside IBC. One-time settlement is definitely, like Pandeyji also said, this is definitely an option which is available for an amicable settlement between the promoter and the lender. Typically, it takes takes weeks and weeks of negotiation to agree on a suitable amount and the timelines within which it has to be paid. It would normally involve a haircut. Haircuts could range anywhere between upwards of 40-50% from a bank's perspective. And such settlements are only agreed or are normally agreed when future recovery options look bleak in terms of the operating cash flows and the security available to a bank in terms of enforcement, etc. If it's a long drawn-out process and the bank doesn't want to wait that long, maybe it's quicker in terms of resource management to enter into a settlement and move out of the exposure. Amount is typically expected to be paid within 3 to 6 months. However, it could extend. Broadly, the sort of 2 parameters that need to be kept in mind is that it cannot be the OTS amount should not sort of be more than 6 months to 1 year. Otherwise, it sort of tantamounts to a restructuring. And one has to justify that the NPV, that the present value of the cash flows that you're receiving under the OTS is more than the future cash flows or NPV of the future cash flows that you would receive under a restructuring or an enforcement of security. I think those, from a commercial perspective and decision-making perspective, this is what one has to keep in mind, which kind of triggers decision-making in this one-time settlement. Moving on to enforcement of security. Yes, options are available, but what are the timelines that within which the security can be realized and the value that is expected after the timelines is a tricky sort of a decision, because yes, most of the lending that is done is secured in today's times, because under IBC, etc., we all know unsecured lenders almost tend to get nothing. But when we look at enforcement of security, timing is very important, because anything more than 6 to 12 months, the value of the security sharply deteriorates. Current assets, one can be almost sure that you will not recover much, because most of the current assets after 6 to 12 months, if they are just lying idle, whether debtors will refuse to pay up, your inventory will just lie as scrap. So not much is expected out of that. Fixed assets like land, building, etc. might have some value. If a company is perhaps being able to be sold as a going concern, yes, there is more value, but then the process takes longer. The tool through which you can enforce your security is obviously SARFAESI, which broadly people are aware of. Moving on to the next slide, this is a quick snapshot of the various tools which were available and the amounts that that have sort of been recovered. If you look at SARFAESI and IBC, like some of my earlier colleagues were mentioning, SARFAESI recoveries rates are about 26%, or the value that is expected is about 26%. IBC almost 45%. So that's obviously in sharp contrast to what we were seeing in Lok Adalats and DRTs. So definitely things have improved from an overall recovery perspective. Moving on, just more procedural. What does a SARFAESI process involve? It involves giving a notice, obtaining the latest valuation, fixing the reserve price. There are a lot of newspaper adverts which we see that banks want to sell off stressed properties. Not all sorts of buyers are forthcoming for stressed properties, because there is generally some caution that people like to sort of keep in mind while buying a stressed property, because in terms of legal formalities, is the documentation okay, will I get a clear title, all of that. In cases like Kingfisher, etc., we have seen it is public news and public knowledge that the assets, some of the assets were some of the good assets were finding no takers, because people were just skeptical of trying to sort of bid for such assets. There are cases where you try to auction a commercial or a residential property under SARFAESI, and a tenant basically comes and says that no, I have been living in this property and etc. So the process gets delayed. So there are various sort of derailments that might occur in the realization of assets under SARFAESI. Some of the examples that we have seen, yes, there was, let's say, an asset which had 4x times cover in terms of land and building, plant and machinery, etc. But just there was no buyer which was forthcoming. In another case, we have seen where within the consortium, there were almost 80 properties of the promoter and promoter group companies which are collateralized to the banking consortium. But when you go to enforce it, the value was just not there. In another case, examples are basically where you have taken security of a ship, etc. So at the time when you give the loan, it was 2.5x cover. But by the time you go to enforce it, because no action was taken, the ships were just lying idle. By the time you actually go to enforce your legal right, you can almost expect zero recovery. So as I mentioned, timing is very important when you are trying to recover, when you're trying to enforce your right under SARFAESI or through asset recovery. The next option that we have is obviously litigation. It's generally not a preferred option because we all know there are costs involved. It is expected to be fairly lengthy. But when there is no other option, I think litigation is the only option. There could be various, within litigation, there could be various options such as, filing in DRT, filing a winding up petition, filing a summary suit that you might have obtained in an international jurisdiction. IBC, we all know, I will not touch upon that. You might have taken certain checks, etc., which in bounds you can initiate 138. Obviously, so you have to keep in mind that the litigation has to be initiated before the expiry of 3 years. Just quickly touching upon some of the options. DRT, yes, it's a procedural sort of a formality. You have to file an application, create all your facts, basically get all your facts in terms of previous documentation, when it was disbursed, etc. File the full history. This is basically generally seen to just protect limitation because the recovery timelines in this are very, very long. Nothing less than 4 to 6 years on a bare minimum. So this is generally not a very preferred mode for recovery. This is generally used for saving on limitation. Winding up petition in the court. Yes, this is used, or this used to be used more frequently pre-IBC because there was a real threat of the promoter losing the company. Again, this involves a full process of the full history, documentation, etc., which needs to be filed. But obviously, it involves the timeline in terms of when the application will come up for hearing and when you will get a verdict. But it does serve as an effective tool to bring the promoter on the discussion table. Summary suits is something that one can use where there are a lot of international where loans have been given in international jurisdictions. They are not necessarily governed by Indian law. They could be governed by English law and under the courts of, let's say, Singapore or some European jurisdiction. What can be done is you basically go and get your judgment from a jurisdiction such as Singapore or wherever the loan documentation is based. You basically get that judgment and try to enforce it in India. That normally is slightly quicker. But there are also some challenges that one needs to keep in mind because in various jurisdictions have their own procedures, etc. And sometimes we have seen that in Singapore, etc., when judgments were given, they were not necessarily by a judge, but it was basically by a low-level practitioner. And although the minutes of the hearing basically said that the defendant's lawyers had no instructions to oppose. And they almost indirectly admitted to a default. But when we try to enforce that jurisdiction in India, there were certain hurdles, etc. So definitely there are practical aspects involved in trying to enforce your right as a lender under the litigation framework outside IBC. And that is why a lot of people draw comfort from the options available under IBC. Assignment to ARCs is definitely another option that is available to try and find a resolution to an asset, because an ARC comes in and tries to give you some money upfront, and as well as there is an option of security receipts where you are able to get some sort of upside. As I mentioned in some of my previous slides, the value that are being offered by ARCs has gone up, but the strike rate and the strike rate of deal closure has been coming down. If there are certain guidelines from RBI, etc., where the offer received from ARC is more than 30% outstanding in cash, then a Swiss challenge method has to be followed, and it does involve giving a preference to an ARC who may be an existing lender. In our experience, what we have seen is when we are speaking to ARCs, etc., if you are a working capital lender, and working capital by the very nature of its facility does not stand to get repaid, because it is almost like rolled over and it is a continuous facility. So we have seen some sort of resistance or hesitation from ARCs to come in that structure rather than a term loan structure, because ARCs typically want an exit. They come in with an exit strategy in terms of how can they recover money, either by repayment or from an equity upside or from a security upside. Typically, they do not prefer working capital structures where the facility is continuing on an ongoing basis. Now, moving on, I think there are some aspects which I thought would be relevant to touch upon, though they're not directly linked to restructuring, because guidelines of RBI for willful defaulter and all of these are separate, and it's a separate sort of a process and a framework that we have to follow. But why it is important is that under IBC, like, we are all aware there is a 29A eligibility restriction, and willful defaulters now are not eligible to bid for their own companies under IBC or under any other framework. So there is definitely a threat that if a company or a promoter has been declared as a willful defaulter or a fraud that I will touch upon in some of my previous slides, there is a genuine risk that the restructuring will not go through. However viable the plan is, however viable the company is, but if the promoter / management has been declared a willful defaulter or a fraud, then there is almost a negligible chance that any credit committee will approve a resolution plan with the same management. Yes, if there is a change in management, then there is a higher chance for things to sort of get approved. Again, economic offenses, this is linked, when we feel that there is a fraud, etc. There's a process which RBI has laid down for declaring the account as fraud, for referring it to EOWs, etc. And this we are all aware in some of the big names which come up, which are involved at the ED level or the EOW level. Just a quick snapshot of frauds. Again, as I said, frauds is a whole separate area which the RBI is looking at. But just in terms of frauds with respect to advances, now, if you look at the number as at September 20, it is almost 110 lakh crore. So that's definitely a big number. And if you look at, we looked at the total gross NPA number, which was almost 9 lakh crores as of March 20. Of that, almost 10% is sitting as fraud. So that definitely is a big number. If you see, I think the reporting requirements around fraud and to recognize fraud, etc., has been increasing, and RBI is sort of driving this in terms of questioning banks when they are not declaring as fraud and why they're not declaring it as fraud. So there is an onus on the banks to correctly and timely record frauds and such things like that. But obviously there is an implication on the restructuring from a promoter's perspective. So that's the only limited point that I wanted to highlight over here. I think to sum it up, I wanted to basically touch upon the fact that when you initiate a lending relationship, relationship with a promoter, there is a certain relationship which is sort of initiated. And in our experience, what has basically come to sort of help us is, if you continue to maintain that relationship, yes, you have to act tough, you have to initiate legal action, etc. But if you are able to still have that trust that yes, whatever the bank is doing is just from a professional reason. There is no, sort of personal. It's not getting personal, and we are only doing our job and trying to find a win-win solution from a borrower and a bank's perspective. If that relationship and trust is still maintained while trying to recover your loan or restructure the loan, etc., I think the value that has basically come out of the process or of the transaction is far more. And I cannot stress on the importance of the relationship, that it is important to maintain with the promoter while this whole process is going through, because without the promoter's help it is very difficult to get the value that you are looking for, or get a good value either from a restructuring or from an enforcement perspective. So I would like to emphasize the overall relationship that needs to be maintained with the promoter to sort of find a suitable and win-win solution from a banker and a borrower perspective. So I think this is what I wanted to sort of quickly highlight in terms of various options available outside RBI framework and outside IBC, and happy to take any questions if there are any.
Thanks a lot, Shailesh. Thanks for sharing your view on the various provisions. Can I now request Kannan to speak a few words, please?
Yeah. Good afternoon to all of you.
अभी मैं जो सैटरडे को बुलाया था अभी मंगलवार को.
Yeah, good afternoon to all of you. When this legislation was brought, the view was that
आपका तो मीटिंग राजेंद्र कोठानी ने रखा है ना 4:30 बजे का.
Hello.
हाँ.
Can you hear me?
If you're not speaking, can you keep your video on mute?
थोड़ा गाड़ी ये लोग दोनों आप दोनों को अलग करना चाहते हैं, समझा इनका गेम. हाँ.
Hello, who is speaking?
We're just trying to figure out.
Yeah, Mr. Man. Heard my name, so.
What's muted the person?
Yeah, go ahead.
Sir, please continue.
Who's
Kannan sir, please continue. Say you're on mute.
Yeah, you can hear me now? You can hear me?
Yes, sir.
Kannan here?
Yes, sir.
Okay. Good afternoon to all of you. I'm very happy to see the two excellent presentations earlier. In fact, a very detailed presentation we had. When this legislation was brought, the objective was what our companies could be saved. And also they set the time limit. But we of course we expected some of the legal hindrances which we saw. So most of the times we found that the number of days actually exceeded. Apart from that, we are not able to even resolve many of the cases. So many went into liquidation also. So when we talk about this insolvency, of course, now we are talking about 9 lakh crores of NPA. According to me, in many cases, the recovery can be more than 50-60% also. You take a case like IL&FS, and we say they have 350 companies. But at the same time, they also went and developed a lot of assets. For example, IL&FS before went into liquidation, they were the leading company for power projects. They had 14 large power projects in their portfolio. They had road projects, and of course, real estate and all that. Now they have decided that they'll sell the BKC block. Like that, if you see, most of the companies which are sick, if you ask me, many of them have got a lot of assets in the form of real estate. So if only we can prepare a kind of plan. If you ask me, the banks should, they have a division for what is called SAMG, Stressed Assets Management Group they have, but they are mainly trying to see how they can be resolved. They can create one more department in each bank, like a consulting wing. Like we have all these big four and all, actually they can even hire this type of people in the bank, where you can look at some of these large assets, large loans, where the money has been spent, and look at what are the assets they have, and based on that, how to monetize assets. So right now, as you are all aware, even government is looking at monetizing the assets of companies like BSNL and MTNL. So there is a very good chance that banks will be able to require a lot of money. We hear in some cases when they were referred to IBC, or when the government says it has to be closed, some of the promoters coming and saying that the bid is only 12,000 crore, 13,000 crores, it is worth 45,000 crores. Or you take a case like Punjab, the bank, cooperative bank in Mumbai, where the assets held by the owners are, the borrowers are more than 4,000 crores. So there are such cases where people say they want to come and settle money, or they say money could be recovered at a higher level. So we have to see these cases. And similarly, in many other cases, if you ask me, I know many companies went on a discount of 70, 80, 85%. And in these cases also, the banks could have recovered 30, 40%. So they have to, not only banks, the regulators, they have to prepare a kind of strategy whereby basically uh, the process is very good. Apart from that, how to identify the assets which can be kind of monetized. It is very well possible. One good thing is that all these companies have got land and buildings. And when these companies were formed, they were all acquired at a very, very low price. Today, the value of these assets are very, very high. So many a times, these values are not reflected in the balance sheet. Balance sheet, when you see, it's only a book value. So it is not reflecting the real value. So, so this can be done. And like it was mentioned earlier, already government has decided that in the case of small and medium enterprises, only if you allow the existing promoter to continue, there is any chance that they can be recovered. Whereas for bidding for small and medium enterprise, you will not get many people who will come from outside and buy. Similarly, even many large enterprises, when you talk about acquiring, unless a company from the same field comes and say that we will take, they will be able to add value and able to turn it around, others will find it very, very difficult, even if they come from some other industry. The fact that they come from some other industry means they have to start from new. So we have to focus on, even when you do the resolution and all that, the asset which is being handed over is handed over to people who are the same industry. So these are my views. Thank you.
Thank you, sir. Thanks for sharing your thoughts on the subject. And they've been pretty true. Like, how we can add value out of the whole process and how IBC can be a good proposition. Well, now I would like
One more thing I
Manoj
want
take
to
up
add.
and
One
start.
more thing
Yeah,
one more
please.
thing I want to add. Here, the practicing chartered accountants and of course cost accountants, all these people can add a lot of value. In fact, banks should have a pool of, let us say, every large bank. They should identify a pool of 100 chartered accountants who can help them in identifying, or they should have valuers, chartered accountants, and people, the companies or individuals who are experts in valuing assets. So they should have a panel who should look at these kind of cases and advise the banks. So that the bank should do. Thank you.
Very true, sir. Sir, we have a raised hand by Mr. BD.
1 minute.
You have anything to
Kannanji.
say?
Kannanji,
Yeah.
that
Yes,
IBA,
sir.
IBA has already empaneled, authorized that monitoring agency like chartered accountants and forensic auditors, and with the process of selection, and that has been 2 times done, and they have now getting quite a lot of major accounts. Consortium leader will select that agency and you will give the account for close monitoring. Similarly, the other one also, and similarly, of course, for valuers, now they have to pass through the examination of the IBC, Earlier, their profession will not be, they have to pass through. And if they pass through, valuers are also getting good business. So your point is well taken, but that has been already taken steps by the IBA.
Sir, but each bank should have a panel, sir. IBC will have a panel.
No, earlier banks were doing one panel. Like, we are also doing a panel for concurrent audit, but another thing is for stock audit and credit audit. All accounts up to a certain amount, 50 crores and above, we invariably give for credit audit. Because as you rightly said, we have to take the knowledge from the real professionals. And cost accountants also, only RBI or that has not been prescribed as a compulsory for that, but banks do take, because cost accountant also have a value to give for the, other than the statutory cost audit which they do for the corporate, banks also are engaging. And this is now has become because otherwise we have to have different sector specialists in the bank. Now which bank also now earlier they had, and now they are taking that sector specialist. But even then, we have to depend on the outside professional support. And those who know, normally send that to, please. Tell me. Kannan?
Sir, it is very, very important because 10% is the NPA. So even if they are able to recover 50% of that with their help, it will be really great.
Yeah.
Thank you, sir.
Yeah, thank you.
We have hands raised by Mr. BD and Mr. Kiran Deshmukh. So I would like one person to please take a question.
Yeah. Sir, my small, I want to know, this 30 days period prescribed that account should not be more than overdue for more than 30 days as on 1st March 2020 to be eligible for restructuring under the RBI circulars of 2020. Is there any possibility of this period being extended beyond 30 days?
Pandey hai, but it is not, I think it is not being extended. It is as per the rule.
Okay. Thank you, sir.
Okay. And a question from Mr.
Can I
Kiran.
ask? Yeah. Can I continue?
Yes, please go ahead.
Okay. The question
Mr.
is
Kiran,
that,
please go ahead.
Yeah, question is that there has been money raising by a private limited company which is definitely not listed, and the money has been raised for quite some time now. Before 2014 they have raised, and now they are finding it to repay it to the people from whom they have borrowed the money. Now these kind of situations are existing, prevailing in the market. Not in my singular case. The money raised are quite large in sum, and I would say this is rather a practice by unethical money borrowers, and they are extending this practice not just in India but abroad also. So as a society, as a country, it is definitely not a good practice. Do we have any mechanism to resolve this situation? Am I clear with my question, sir? Mr. Narendran?
Yeah, I heard that, I thought Sanjeev, because they're all existing bankers.
Right,
this company has access to that, company, somebody should complain to SEBI or somebody has to complain to RBI, because they have without approval from the RBI, no company can accept deposit if they are a lending institution or anything. That NBFC with the power to accept deposit, those institutions are closely monitored by the Reserve Bank. Now any company simply taking money as a deposit and all that, other than that, otherwise they will come under the Companies Act. That again, that Companies Act will look into that. Then you have a action against that. Now you are talking on behalf of the company or on behalf of the people who have been grieved out of that money giving and now not getting the money?
Yes, we are among the lenders.
Huh?
We are among the lenders.
You are the people who have lent money to that.
Right.
So that is no, you should have been aware of the risk. You means anybody.
Yeah.
That is a clear cut which RBI, so many times they are giving awareness who are authorized to accept deposit, who are not authorized to accept deposit. And the other side, if a listed company and all of those companies under the Companies Act, they have the this one to accept deposit. Now, if these company, what you are referring is not coming under that and all, just like that, no, the local Nidhi deposit, this, that, and all,
No,
chit
no.
fund, that.
It is a formal company, a private limited company.
भैया वो company ठीक है, but उनका where they were give, and they are not authorized to accept.
They are not authorized. But yes.
So similarly, that that when you are giving investors be aware, that is very important of the risk. And if they have diverted the money for some other purpose, all of them, one overnight company will come and overnight they will die. So
yes,
that companies cannot be trusted.
Yes, you are right. Whatever you say is fully agreed and is well understood now.
अभी आपको ऐसा है तो if they are listed or what you call limited company with the coming under the Companies Act, as that you have to I think the Department of Corporate Affairs, there you have to come, and MCA you have to complain, and they may order investigation, serious fraud investigation office and all, they may order, provided a lot of people have been affected, and similarly criminal complaint has to be given.
Right. So, do you have any link or website or corporate or rather authorities where I can address this question?
These are generally available on the net. Like you can only search for
the links.
This is
to all the professionals.
This is beyond the purview of the today's discussion. So
yes, I know that.
You have to find on your own, and that you can take a. I think any person who is dealing in corporate affairs or those of the chartered accountants and who are all here specialists, you have to take their help and they will help you.
Yeah, I think all the professionals who are engaged in this meeting, most of them are
you have to contact them
only.
You have to contact them personally, and if it is such an eminent subject and they feel it is good, and after seeing due diligence they will look into that. That is their level of whether they should take it or not. Am I right, Kumar Kannan?
You are absolutely right, sir.
Yeah, you are right, sir. Right.
Yeah.
Okay. I would now like having the open house on. Can I request Sandeep Bhat to please share his thoughts about the market? Like
before I
request
actually
Sandeep also to give his open.
Before thank you, Sandeep. Namesake. Before I actually get into the markets, actually, what I wanted to, and first of all, thanks to all the three speakers who have actually given us a thought-provoking, session and presentations on all the aspects of IBC as well as the NCLT, as well as, in fact, Shailesh also mentioned the practical aspects of what is done with defaults as well as the ARC. Now, I had certain questions on these aspects. One is there is a thought process where people are reluctant to actually go in for a OTS when, with the feeling that once they go for a OTS, is there something where they get the CIBIL scoring or the rating or whichever rating that gets impacted? Is that so? That is the first question. And the second question which I wanted to ask, and not ask actually, this is something which has been bothering me for quite some time, because I have myself come across at least a few cases where, there's a cutoff of 1st of January 2020 for all these, appreciation of the government giving grants and, helping out the MSMEs. Now, what happens to a person who is not a willful defaulter, who's been going through the pain even prior to that? Because, we understand that the economy has not been doing well for the past year or so, even before the the COVID incidents. So what is there in store for them if they have become NPAs even prior to 1st of January 2020. If somebody can actually throw light on that.
Yeah, I'll take that. So your first question is that if you go into OTS, so will there be a blot in the credit history of the company?
That's right.
Yeah. So basically now, because the entire credit history is recorded, so it will obviously come into your case that some OTS has been settled. But I think it is better than your history having a default. So it's not that bad that you had a OTS, rather than having a default and then the lender going to court and you going through a litigation process. I think OTS is much better position than a litigation for recovery. That is one. And your second question is that MSME already facing stress before this COVID. So I think there are already schemes. Before that also, RBI came out with some MSME restructuring schemes. Every bank has its own scheme. My bank keeps coming out with OTS schemes also for MSME customers. Recently, we closed one scheme in October, where all the MSME customers with the credit limits up to 50 crore, they were offered a very, very lucrative OTS thing, and I think many people have availed that. So I think both banks and the government, they are quite concerned about the support to MSMEs, and we keep coming out. It is only thing that you have to take the benefit of those schemes.
The only problem is if the promoters themselves don't have the capital to actually come out with the OTS. Yeah. That's the issue. So what they are afraid of is obviously their projects are good. In the long term, if they revive, the projects will be very good. The issue is they will have to sell at a valuation much below what they can achieve in the longer run. So that's the problem people are facing.
Yeah, well, agreed too. The only thing is that, see, this valuation is again like nobody sees the long term. No, the bank who is having a default at hand today, his best concern about the high concern is his balance sheet, not your balance sheet. You appreciate me? See, for a bank, he is more bothered about bank's balance sheet than the borrower's balance sheet, because he also has to survive in the market.
That's
As
true.
you already saw the figures, the banks were having NPAs up to 10%. I think there are banks in the market who are having NPAs something positive of 25% also. There are banks. They are still there, but they are. So for them, their survival is also at stake. So they cannot wait for long term to the money to come back, and then there is a pressure from RBI. And one more thing I have to add here. One thing that IBC has changed, if many people don't appreciate that, is that earlier the timeline given for a NPA loan was around 4 to 5 years to recover, right? You see the IRAC circular, you have 1 year for substandard, then 2 years for substandard, doubtful 1, doubtful 2, doubtful 3. So bank easily could stretch a NPA account for 4 or 5 years and take the process, including OTS, negotiation, everything was going on. After IBC, that process time has been squeezed to 1 year or maybe 1.5 years. Now, IBC can take a company to liquidation within 1 year. Agree? Similarly, even the resolution framework, the timeline for survival of a company has been squeezed from 5 years to maybe 2 years. So we should keep sense of that timeline. So now you have only 2 years to survive. Earlier, you could get time up to 5 years. That is my.
Okay.
Thanks. I would like to add here a couple of very important issues raised by the participants in the chat. One is about employees bidding in the IBC process. Well, internationally, there is a trend for many years about management buying out. And there is also funds available from PE investors for buying out. So this is a thought I would like particularly Mr. Pandey and Mr. Narendra to share. Another point was on shareholders. What is their fault? They tend to lose out. In a few cases, which was shared, shareholders have benefited, but 90% of the cases they have been losing out. Of course, a window is available now of a small percentage where they can benefit after the lenders are benefited in terms of getting back the money over a period of time. This is also important issues raised by the participant in chat mode. I'm glad such issues are being raised, and we are addressing it. Some inputs from you, Mr. Pandey and Mr. Narendra, on these two critical issues. Then we'll have something on Bank Nifty from Sandeep Bhat.
Mr. Narendra would like to take?
Yeah, no. I'll first Sandeep ji, that earlier आपका question. Suppose that particular company or whatever that has been affected due to adverse happenings in the industry per sector. Suppose there is some unseen things happening globally or domestically on that sector-wise issues. Then the rating agency will see when the sector aspect will improve. Then they will look at. But if it is due to their mismanagement, due to their lack of or diversion, or they have not pumped in enough capital which they have committed to the project, then naturally if they are going for OTC settlement, their particular account will suffer in the rating. But similarly, it is also not that the OTC account cannot get facility. But in the bank, same bank who has given OTC can give facility to him, provided he agrees for the whatever haircut, both the principal and interest, he has to bear again back to the bank. He has to pay, okay, first I will pay this, next year I will pay this. So if that is there in the board, they can take it, or management level. And if otherwise he is found in all fit, that party is good, except that it was due to various extraneous reasons, he may be again funded also. That's why his enterprise nature will not be suffering. He can continue with the enterprise. That position, even when he goes to another bank also, they normally insist that OTC account that you have to make good for the loss for your original bank. That is a priority. Now, we of course on that IBC and other things, Manoj, our Sanjeev is very authority. But I found that recently employees also have bid in the case of Jet Air, I think Indian Airlines, that not for the government disinvestment, they have bid for with the 50% by them, 50% maybe support by the outsider. They have bid. Similarly, even in so many cases, they have bid, but it is a open tender process. If their process technically and on the financially, if it is found suitable, then ideally that offer can also be considered in the method which is followed by the committee of creditors. So, and then they will go to the NCLT through that filing that resolution plan. So employees' interest per se, if it is a going concern and all, the new management also will take into account the employees' what you call specialization, knowledge and all, and they will get in the new management also continuity of the job. So that is on the employees. Now, as per my knowledge, suppose you say recently Yes Bank, when they went into the problem, the Reserve Bank had to write off whatever this one, that tier 2 capital or the perpetual capital, because the perpetual capital per se, that if there is a liquidation or if there is a loss, and if that is not, so they have to lose the money. So the perpetual capital has a better yield, but with the risk. Same way, now I think recently LVB Bank, Lakshmi Vilas Bank, was taken over. Was taken over by DBS. In that proposition also, the promoter as well as the other shareholders, I think as per my knowledge, that DBS has to pump in only 2,500 crores to the bank, but all other that has got completely wiped out. So now, if for your information, even in futuristically, there was a guideline to come as per our signing of the G20, that in case of any difficulty in terms of the suppose financial institution going into problem, the depositor also will come in par with the as a equity holder, and that money also can be used for paying the outstanding liabilities. That is but unfortunately, of course, that law has not been passed by the government, and government is still examining, and they have enhanced the insurance cover. So your point is, in the scheme of things, the old shareholder also will continue, and their shareholding is taken care by the new management, then the old shareholder will get value maximization. But if the new management is, actually it is a continuing company. So going company, the new management taking, I think shareholders' interest to the limited extent will be protected if it is a part of the resolution plan. This is my knowledge. Other thing you can ask Pandey ji. Pandey ji, हमारा correct है?
Yes, sir. You're very correct. Yeah. So basically, from employees, as he was asking, no. So many, we have seen like 4 or 5 cases in NCLT cases. The employees have come forward. One I remember, the Ride and Tailor, where the employees have submitted a resolution plan. The good part of the IBC is that anybody can submit a resolution plan. It can be individual, it can be a cooperative, it can be a society. Anybody is free to submit a plan. And I think gradually a market is developing for support of these kind of bidders also. One is that there is some, the funds, foreign funds are coming in, who are ready to provide funds to these people to get funding for the plan. Secondly, they can contribute their claims as a funding. Like employees have a claim equal to the financial creditors. So their ranking in the IBC, especially for workmen, is equal to the financial creditors. So whatever financial creditor get in a resolution plan, equally it has to go proportionately to the employees or worker claims. So they can contribute that part of their claim as a part of the funding of resolution plan. Then their PF gratuity dues, they can be contributed. They can always go back to a bank to get funding. So that is the new product coming up. We have funded 3-4 cases of IBC, including Bhushan Steel. I think the other one is this one, Ruchi Soya, where banks have funded the resolution plan. So that is another possibility for employees, that partly they can contribute and partly they can go to another bank to get funding for the resolution plan. So all these possibilities are there. One more possibility for OTS, as one gentleman was asking. Now another product is coming to the market, which is like compromise funding. So there are people, there are funds in the market who will be ready to provide you funds for the compromise proposal also. So there are many opportunities and possibilities being opened up by the IBC. Another one is like the litigation funding. In many cases, most of the debtors' claims and other claims go waste once the company goes into dissolution. So now we see there is a interest from international funds. They are coming in for litigation funding also. So they will be able to take over the claims, actionable claims, as well as fund the recovery of claims. So all these things are.
Yeah, off-balance sheet items like arbitration award and other things,
yes,
there will be funding. So that becomes a separate part of that, and the funder can have access to that later. That is correct.
I would now request each panel member, each expert to answer very crisply on the most important point in 2021, to what extent the banks will be able to raise capital. There's a big opportunity ahead. FIs are interested, DIs are interested, mutual funds are interested, and the public are interested. HNIs are interested. There is huge oversubscription in IPOs and FPOs also. Very, very crisply, each expert on the panel answer about the ability of the banks, whether private, whether PSUs, or whether others also in financial services. And then we would have the Bank Nifty chart for the year ahead. Starting with you, Mr. Narendra, then Sanjeev Pandey, Mr. Ramesh, Mr. Rathi, Shailesh, and Mr. Kannan. And also, we'll have the open house view. Everybody is welcome to put on their comments on the chat mode about the prospects of the banking sector. It's a big global opportunity. The best budget also may be ahead of us.
Yeah, Manoj ji, abhi just in the initial period of COVID itself, the new generation private sector banks raised around 70,000 crores capital. And that is followed by a few public sector banks of bigger size. They also, IPO means your follow-on issue or plus your tied to capital, they raised around 25,000 crores. And other day, the finance banking secretary has mentioned that just not due to the capital requirement per se, but because the Reserve Bank also mentioning that all of them should have a buffer, not to meet the pandemic shock as well as any other shock coming after the government, all these measures are what you call why it will be taken back, or also to see some unanticipated such losses, so that there is a move by the government of India also for all of them, that you must start aiming at IPO or your through market. And recently, I think Canara Bank raised, and some, and now even Punjab National Bank has a plan, and I think later State Bank also, that he Pandey can say they are also having plan. So all of these merged and stronger banks will come with the market also. They will give chance for the what you call institutional placement as well as the retail investors, and they all a large investors base. And it's also a potential good issue in the sense some of them public sector bank per se, this is my view, but I cannot, because that shares are what you call quoted, or that the valuation has come down only due to the some this type of feeling that but the real intrinsic value of these shares are much larger. So if the legacy loans and other things are already covered by provisioning, and the provisioning coverage also has gone up now 67, 70, and even some banks 80% provision coverage, and all the old accounts and all 100% coverage. With that type of coverage, and which on recovery through IBC, Moses or whatever, that money will come back to the profitability. So they're able to raise the capital, and those who enter capital by subscribe shares will have a futuristically, if the economy comes turned around and comes with the 10% growth in the next year, and then average 7 to 8% growth, I think banking sector shares also are going up. Apart from that, the government has provided another 20,000 crores in the interim budget for giving capital to these public sector banks. And of course, that these banks will conserve capital in a way that they will also conserve capital, they will enhance the profits, which are all now visible, except for this COVID shock came. Had that not come, ideally these banks were already in the recovery mode. So that their shares are also likely to come, and it can have a good acceptance. This is my view.
Very good view.
Yeah.
Yeah, I think Mr. Narendra has covered most of it. I'll just add few points. Like one is currently the public sector as such, and public sector banks particularly, they are not getting valued to the underlying value they share. Most of the market price must be below the book value. So I think there is some perception game here, like private sector banks are being perceived as more efficient or more this thing, and of course they have some lesser NPA. Reason obviously is because they never lend to any risky assets. They never lend to infrastructure sector. They never lend to road sector. So they never took a risky game, entered the risky game. Whereas public sector bank, being the custodians of the progress of the country, we have to lend even to riskier assets, because without doing that, that will not take off. Your infrastructure would not have taken off without us funding the infrastructure. So that is one point. So I think some perception right now is slightly negative. So banks will be waiting for the right time and right sentiment to appear in the market. Like if you look at the SBI share, so I think even if you value the subsidiaries itself, the value of the share must be much more. Just value the SBI card or SBI Life, SBI General. There are many listed subsidiaries. If you just tie up the value of them and put the value to the share, it may be much higher to the value we are getting today in the market. So I think there's a perception game. Second thing is that because of IBC, the public sector banks have seen a considerable recovery, which is actually a contribution to the capital itself. Like in most of these large accounts, they were 100% provided already. So when we got the recovery under SR Steel, so it was a 100% addition to my capital because the provision was written back. So that is also adding a comfort factor, whereas we are not desperate to go to the market. So we will be timing the entry to the market. And I think that time will come because now already the private sector banks have started going up. They are quite well off after the lowdowns. So I think next stage will be the public sector. And third factor is that the banking is a sector which gets hit first in any slowdown and which gets benefited first in any pickup in the economy. So that is already happening. That is visible. I think we'll be able to see in the December results and then March results. So that will add to the strength of the bankers, the balance sheet, and then they can show the EPS to the market so that they get better valuation. So rather than immediately entering the market and selling share equity at a low price, I think they will wait for 3 to 6 months to enter the market at the right time. That is my personal opinion. Thank you.
If I correctly told. And another thing, like all of you may be, of course, each bank may vary, but whatever capital provided by the government, I saw one paper report, the current valuation of that bank shares, public sector, has gone up by 14%. But in some banks, it may be lower. But overall, currently for government, that has given positive valuation. So, but the implied positive value incremental, that will be much, much higher. And another important, Manoj was asking yesterday night, that the strategic PSU, that as per the Atmanirbhar Bharat, that government decided that we will not have more than 4 PSU units in each sector. Now, there was some paper report that even in the bank also, whether because it is included in that, we have to see. Banks also are going to have not more than 4 public sector bank. And in that case, a few banks have been lined up or suggested by the maybe Niti Aayog or internal study that they can be taken in the event of government drive for disinvestment and all. But whether that will also come in the recent immediate past or in over a period of time. Of course, overall, another issue of your webinar was the disinvestment per se in the current year has not received the so much impetus, and they were able to take lesser money. But pipeline, the BPCL, LIC, and Air India already there, and Shipping Corporation of India, and some more Cement Corporation of India, and they have also identified. So the overall target this year may not be, but due to the COVID only. But the lined up for the next this financial year, there will be a substantial disinvestment taking place. Now, for the opportunities for the bank, in the infrastructure space itself, 111 lakh crores in the next 5 years. And quite a lot of them are road, railway, port, and all that lined up. And I am sure some of the bigger capitalized banks will take a share in that. And of course, there is an opportunity for another DFI also to be established. And the government must be thinking on that. And some of you who are interested, I am not for time. The RBI itself, as governor, has identified 10 sectors where banks should take the new area of growth. So these 10 sectors are all sunrise sectors, and like pharmaceuticals, all that, which are now after COVID going up. So banks will now start looking at funding also because of the liquidity and all. So after some time, the credit growth also will pick up, and the profitability of the bank also. This is our presumption, and it has to happen actually. And as I do agree with that, some of the new generation banks are very focused on some sector only. So that is where they are in a different mode. But public sector bank has to be looked at the major role they played on the inclusive growth as well as infrastructure development, and giving a boost to the GDP growth. So when the economy starts moving with our drive for reaching 5 trillion economy, I'm sure banks will get opportunity, and banks will come back with the profitability also.
Yeah. In terms of capital, so since you're talking about growth and 5 trillion and all that, we require we require a lot of money in the system, like Mr. Narendra said, 110 lakh crores of infrastructure and all. And most of that, how it is going to happen is that government is speaking to, they spoken to these 20 large institutions. As you are all aware, this the JBIC, the Japanese institution, already they invested, I think, $1.5 billion in both SBI and NTPC. Canada funds itself is about $60 billion in India. Japanese funds are already 60 billion as of today. So there are already 120 billion they invested. Now investors around the world are looking at investing, but all that money has to come through banks. So one of the estimates of RBI is that once these concessions get over, RBI expects that the NPA levels will go up. So when the NPA levels go up, the estimate is that at least 1 lakh crore of capital is required by these banks. So 1 lakh crore means they can mobilize another 7-8 lakh crores to lend money, 9 lakh crores. As of today, our NPA is about 9%. That is about 9 lakh, 10 lakh crores. That is the NPA today. So once they raise this 1 lakh crores, then they'll be able to raise another 8 lakh crores through other modes, which they can support for growth. And like it was mentioned by Mr. Sanjeev, one of the issues today is that the valuation of banks, especially PSU banks, many of them are quoting at 0.3, 0.5 of book value, which is very, very low. But if you really look at the underlying assets of these banks, all these PSU banks, they have quarters in almost most of the cities they operate. If you just look at their real estate itself, is a very good valuation. I remember 4 or 5 years back, there was a move by finance ministry where they said that some of these values can be captured by banks and it can be reflected in the balance sheet. I am not aware what is the status. Maybe Sri Narendra and Sri Sanjeev, they will be able to comment whether they were able to identify these assets and say that they can be kind of reflected in the revaluation of assets in their balance sheets. I am not aware. But certainly, like it was all mentioned, every private sector bank, they are focusing on only few sectors. So it's obvious because the private sector, they are mainly focused on the shareholder wealth and shareholder return. So they are very, very careful. The fact that some of the banks and the leading banks, they have reached 4 lakh crore market cap, shows that they never went into sectors which are risky. But they are very, very careful in lending to sectors where they get good margins. So going forward, if you ask me, like it was mentioned by Sri Narendra, the first 3-4 months itself, all the private sector banks, they raised capital of 60,000-70,000 crores. Now the estimate is that the RBI and finance ministry, they are feeling at least 1 lakh crores have to be mobilized as a capital by the banks. So if you ask me, if you are talking about high economic growth, if we talk about high funding, then certainly capital is required. But one more factor we have to keep in mind, as of today, all the banks are sitting on a liquidity of 7 lakh crores. So every day they are not able to utilize, they put the money with the RBI in the repo. That so first, as it was mentioned by Sri Narendra, so 10 sectors they identified. These banks have to start lending. So far, they are not lending one, and of course, second was why they are not lending was also most of the large corporates are operating at less than 70% capacity today. Only when they reach 80%, they will think about setting up new plants. So only when they think about setting new plants, then the credit demand will go up. Otherwise, credit demand is there, but that is for sectors where they are really in trouble. So when you lend money to these sectors, obviously the NPA will go up. But capital raising is the only way where the banks can also kind of recover, plus they will be able to fund. These are my views. Thank you.
Well, it's been a long time. Like, we have spent around 3 hours and 10 minutes discussing on various aspects and various things. I thank all the participants, the speakers over for their valuable time and sharing their knowledge. I would like to thank Mr. Narendra. I would like to thank Mr. Sanjeev Pandey. I would like to thank Mr. Shailesh Agarwal, Mr. S Rathi, Mr. Ramesh, Mr. Kannan, Mr. Sandeep Bhat, each and everyone. And I would like to even thank the participants who have been with us all the time and even trying to put forward their questions. All questions have been pretty good, pretty well answered by all the people over. And I would like to thank Manoj for the initiative, and where we are trying to have this session every week on week, so that there can be knowledge sharing taking place all the time, and that will really be helpful for us all professionals to grow ahead. I would like to say that on the next Saturday, again on 9th January, we are having a seminar, the session again, which will cover the digital and the cyber security space. Considering the current digital economy and where everything is getting online, it has become important that security has to be given a lot of importance so that everyone can stay well and good. That's all from my side. Anybody like to say anything? It'll be a pleasure. I hope
I
you
would
all
like to add.
enjoyed your session being with us.
Yeah, I would just like to add, it's a very good, the panel speakers talked about sectors and identified by the RBI also. The sectors, the market rewarded in 2021 in India were pharmaceuticals, was IT, and financial and banking sector. We are in the top three. As indicated by the expert participants, there is huge opportunity in the banking and financial sector. Also, indications were there. Intrinsic value is much higher. That also the experts shared. So I hope the financial and banking sector would continue to be in the top three, and regularly sessions are on, and the wealth management series is continuously on week by week, along with other experts in all the domain areas from each and every sector, knowledge sharing with practical issues, live issues, really wonderful. And I would like to thank all the participants, all the expert panel members, and wish everybody a great and wonderful 2021. Thank you very much.
Thank you, Manojji. Thank you, Narendraji. Thank you.
Thank you.
Thank you. Thanks a lot. Thank you.
Fine work you are doing. So on behalf of our speakers also, we thank the organizers for doing this grant. And our services are available always. Okay.
Great, sir.
Thank you.